Okay, so we are going to be looking at consolidation. So we might not solve questions under all the issues under consolidation, but we will try and see if we can do our best under the consolidation. Okay, what you have to know is that, okay, you have to still revise what you have been taught and what you have been learning. Over here, we are just coming to solve additional questions to, let's see, and see if you can actually what get more understanding of the issues. We are not coming here to solve questions that will come in the exam. So if you are putting your mind that you are coming here and we are coming to solve questions that will appear in the exam, please take that one out of your mind with all due respect. We are just coming to solve additional questions to establish more understanding of what we have been doing so far. So we are just here to solve questions and we try and do our best so that we can actually take something to wherever we are going after the class. Okay. So if you come to consolidation, we have five major issues there. Okay. If you come to consolidation in corporate reporting, we have five major issues there. And those five major issues, we try and see if we can cover what some of them during our stay on this particular blue app. Okay. So let me take those issues one by one. Okay, I'm not going to be talking much because we are going to be solving questions and we are going to be explaining what the issues when we start solving questions. So if you come to consolidation in corporate reporting, consolidation in corporate reporting. If you come to consolidation in corporate reporting, the favorite area for the examiner, the favorite areas, okay, we have what we call step acquisition, okay, or acquisition in stages, okay, acquisition in stages, which we call the step acquisition, okay. Another step acquisition is very simple. You see, under financial reporting, what we learned is that the parent or the investor will just acquire in a single transaction, will acquire more than 50% of the shareholding of the investee, and control is going to be achieved in only what one transaction. But in reality, control can be achieved in so many what transactions. It can be more than two, more than three. Okay, you don't know the nature of the company that you are going to be acquiring. So what you do is that you want to do what we call, you want to test the water. So you buy at least 20% first. And you say, well, let me buy 20% and see what is going to happen. It's just like you are going to buy food from a place that you haven't bought food from before. So what you do is that let me buy 5 CD to check if it is if it will be sweet or if it will be nice. After buying the 5 CD, you realize that, oh, this food tastes nice. So you are going to be buying additional quantity again. The same thing applies to if you come to step acquisition. So you don't know, you haven't been there before. So you say, let me buy 20%. So after buying the 20%, you realize that, oh, this company is doing well. So let me increase this thing by 25% again. Still, you are having less than 50%. Although less than 50% can give you control, but in the examination hall, it should be more than 50%. If you have 50%, that is a joint control. Okay, we are going to be talking about that very soon. So you say, okay, after 25%, you say, well, let me buy additional 25% again. At this particular date, you are having a total of what? 70%. You have achieved what? More than 50% shareholding in what? In different transactions, in three different transactions. This is what we call step acquisition. You can also acquire 60% first and decide to acquire additional one. That is also a change in a growth structure, which is also captured under the step acquisition. This is a new syllabus. They can decide to examine the step acquisition as a first question under what? Under the consolidation. Then the next one is a complex growth structure, which has examined more than any of the issues under what? Under the consolidation. So we have the complex growth structures. Okay, the complex growth structures. So the complex growth structure, what is going to happen is that you are buying a subsidiary and that particular subsidiary is also buying another subsidiary. So indirectly, you are also buying the other subsidiary. So we have the growth structure to be more than one. Okay, so we'll be looking at the vertical shape and then the D shape. Okay, so that is it. So if you come to consolidation, we have the exceptions. One of the exceptions is that A parent who is a partially owned or a parent who is partially owned or wholly owned by another parent cannot consolidate. That is the issue of the complex group structure. So you have more than 70% or you have more than 50% in another company, and I'm also having more than 50% in your company. You cannot what? You cannot consolidate the other one because I'm coming to consolidate you. So if I'm consolidating you, I have to consolidate you with other what operations that you are engaging in. So we have the complex group structure. This is the what? This is the most examined what area under consolidation. Okay. Then we also have a change in the group structure, which we have what we call disposal. Okay. So you have acquired more than 50%. The subsidiary is not doing well, and you want to what? You want to dispose, or you want to now take off your investment from that particular one. So you dispose the subsidiary. You are going to be disposing your investment in the subsidiary. You can dispose and you will not be having any shareholding again. You can dispose and you'll be having less than 50%. You can dispose and you still be having more than 50%. How do we go about those issues? Okay, we'll try and see what we can do under that particular issue. You can also have what we call cash flow. So they can ask you to prepare a cash flow for a group. This has not been examined, okay, before under the old syllabus. So it is possible they can actually bring it. Anything can happen. So we come to the last one, which is a foreign subsidiary. So a company in Ghana is having a subsidiary in Nigeria. Okay, we are coming to consolidate. So a company in Ghana is having a subsidiary in Nigeria. The company in Nigeria is going to be presenting its financial statement in the what? In the Naira. And we are coming to present our financial statement in the Ghana cedis. We're having two different presentation currencies. So if I'm coming to consolidate that particular subsidiary, I have to what? Consolidate the subsidiary in my presentation currency. So we have to translate their what? Their operations into the Ghana cedis. So we have to translate, or we have to present their financial statement in our currency. And there's going to be some issues over there. If you are doing profit or loss, for the foreign subsidiary, profit or loss, we use average rate to translate their items. Okay, we use average rate. If you are doing statement of financial position, we use the closing rate. So the exchange rate, which we call the closing rate, we use it to translate it. So statement of profit or loss is average rate. Statement of financial position is what? Is closing rate, because that will be the figure as at the end of the year. So we use the closing rate. Okay. What else can they, apart from these ones, we can also have a complex group structure where there will not be any. What will happen is, okay, apart from this one, there can be a complex group structure where the parent will acquire two different subsidiaries. They can also give you a question like that, and they have given questions under that one for like 3 or 4 sittings. So they can give you one parent will be having two subsidiaries. Okay, one parent will have two subsidiaries. What it means is that the parent will acquire two different subsidiaries. So the parent, which is A, can acquire B at the same time acquire C, or even acquire D in addition. That's also a what? Example of complex group structure. Okay, so that's what we are going to be doing. We try to see if we can solve at least one question under each of them. If we are not able to solve it, then you have to look at those ones yourself. So that's what we are coming to do. How do you approach exam question? In the exam, how do you go about a consolidation question? You first of all have to establish whether you are doing statement of profit or loss, or you are doing statement of financial position. If the question is asking you to prepare statement of profit or loss, what are the workings that you have to do? If you are doing statement of profit or loss, this is what you have to, this is some of the things that you have to do. If you are doing statement of profit or loss, this is what you have to do. Okay. If you are doing statement of profit or loss, identify who is the parent. Okay. Identify who is the parent. So if you know the parent to be A, you have your revenue. Just copy the what? The statement given to you. They will give you the statement of profit or loss. Just copy the items like that. Revenue, cost of sales, gross profit. Don't write any figure. Administrative expenses, distribution expenses or cost, finance cost, other income, profit before taxation, and those issues. Copy them. Identify who is the parent. The parent is going to be adding the subsidiary figure to its own. So after identifying the parent, just come and write the parent figure here. Cost of sales, write the parent figure. So you write a figure for the parents. Okay. Then you scan through the question to know who the subsidiary is. Then, if you know the subsidiary, when was the subsidiary acquired? Sometimes they can give you a question where the subsidiary will be acquired 9 months to the end of the year. It means that the subsidiary has done 3 months before the parent has acquired the subsidiary. In that case, the parent will not have control or the parent will not have the share of the 3 month profit before acquisition. So you only consolidate the subsidiary for 9 months because the parent is going to be having a share of only 9 months profit. So you calculate only the 9 month profit of the subsidiary and what? Find the parent and then the NCI portion. So if it is 9 months, you come and add a subsidiary 9/12. That is if the subsidiary is going to be there for the full year or the subsidiary is still there. But if there was a disposal, you ask yourself, when was the subsidiary disposed? How much has the parent controlled the subsidiary before the disposal? If the parent still has control over the subsidiary for 6 months and the subsidiary has been disposed 6 months to the end of the year, the parent will have share of the first 6 months. So you consolidate for the first 6 months because you want to know the profit made by the subsidiary for the first 6 months. Then the parent will have each share of that. So you have to establish whether it is a step acquisition or it is disposal. If it is step acquisition, consolidation starts from where the parent has control over the subsidiary. So you identify that, then just put the parent figures there. Go and allocate the subsidiary. The subsidiary is in front of you, but go and read the footnote. Come through the footnote to see who the subsidiary is. If the subsidiary is B or A, for how many months for this particular year? How many months was the what? How many months here that the parent will be having of the subsidiary profit? Is it going to be a full year? If it is going to be a full year, then you add the subsidiary figure to the parent own. If it's not going to be full year, for how many months? If it is going to be 2 months, you do 2/12 because the question will tell you that assume that all income and expenses are accrue evenly throughout the year. So it means that every year revenue is the same figure. Every month, the revenue that we have, if it is 12,000, it means that every year is 1,000. So 2 months will be equal to what? That will be 2/12 multiplied by the total revenue, which is the 12 months. Then you do that and come to whatever you are coming. Then you come and take the footnotes one by one now. Okay. You come and take the footnotes one by one. Yeah, I saw a hand up. Snatchers. Snatchers, your hand is
Hello,
up.
good
Yeah.
morning, sir.
Yeah. Good morning, Zina.
Good morning.
Yeah.
Please, I was just asking, if you can more into what you are, can you do more for me?
Yeah, you said your network is your network is
No,
more. Yeah.
I was saying that if you can raise your voice small,
Okay.
if you can raise it small,
Okay.
I'll be grateful.
All right. Thank you. All right. Okay, so that is about the statement of profit or loss. So you just have to identify what are the workings that you are going to be doing. Okay, we might be taking a question that will be bringing issues like that. What will be the workings that you are going to be doing? Okay, what will be the workings that you are going to be doing? The workings, whether you are doing statement of profit or loss or statement of financial position, the group structure is going to be coming there. Okay, so the group structure is going to be coming there. Whether you are doing statement of profit or loss or statement of financial position, group structure will be coming there. What will be the next one? Please, we don't do net asset for profit or loss. The net asset is purposely to determine what? Post-acquisition profit, the profit that will be shared among the NCI and then the parents. But if the question is asking you to calculate goodwill, if the question is asking you to calculate goodwill, or there's a footnote talking about impairment of goodwill, which the impairment was not given to you as a figure, the impairment has been given to you as a percentage. That means that you have to know the goodwill at acquisition or the goodwill arising from the acquisition. Then you now apply the rate of impairment on it. So in this case, you have to calculate your impairments. Okay. So if the question is asking you to calculate impairments, the question is asking you to calculate impairments where you have been given what a rate, then it means that you have to know the goodwill before you can what you can actually what know the impairment on the what on the goodwill. But if a figure has been given to you as impairment figure, please, there's no need for you to do goodwill. Why do we calculate goodwill? We calculate the goodwill to know the goodwill that will be appearing in the what in the statement of financial position. That's why we calculate goodwill. But if the question is asking you to do goodwill or they are giving you a rate of impairment on goodwill, then you have to calculate the goodwill and know the what the goodwill arising before you know the impairment. And in this case, you are just going to be doing your purchase consideration. Under this one, you do your purchase consideration. The how much is the parent paying? Okay, what is the portion that the parent is not taking? That should be taken away from the net asset. But since we are using the total net asset, we should have taken the NCF from the what? For the total value of the company. Then we know the portion that the parent is paying for. Okay, so we add the NCF to that one. Then we do our net asset at acquisition. You do the net asset at acquisition in the goodwill calculation. Okay, so you have your share capital and those ones. We calculate it from the what? From the equity perspective. Then you do your goodwill and do the impairment. If you are doing statement of profit or loss, there is no need for net asset at what? At reporting, unless there is something about disposal where you have to calculate a loss or something that you want to know. Okay. If you are doing statement of profit or loss, there is no need for net asset at disposal because the profit that you are going to be determined, that will be shared among the NC and the parents, will be determined from the statement of profit or loss. The profit for the subsidiary will be determined from that area. So there is no need. Group return earnings, there is no need. We are not going to be showing the retained earnings of the parents. We are only going to be showing that in the statement of financial position. No need for NCI, unless the question is asking you. But you can do other workings like depreciation on fair value adjustment, deferred tax issues, or provision for unrealized profit and those issues. Those ones we can actually do them. Okay. But if you come to statement of financial position, if you are doing statement of financial position, what are the workings that you have to do? And how do you approach it? Identify who the parent is. You are consolidating. You are adding the parent and then the subsidiary figure as if they are a single economic entity. So just the parent figure, you're not going to be doing anything. Just determine the parent figure. Determine whether the subsidiary is going to be there at the end of the year. What it means is that is the parent going to be having control at the reporting date? Is the parent still having control over the subsidiary? If yes, then it means that the parent is still the owner of the subsidiary at the reporting date. Then you still add a subsidiary figure. Then you count your workings. Identify the subsidiary one by one. You count your workings. Under corporate reporting, the first company will be the parent. The second one will be a subsidiary. The third one will still be a subsidiary or a sub-subsidiary. Okay, it depends. I don't think they are going to be giving you a question where there will be an associate, but it can happen. But just pay attention to, just determine the parent, the first company, unless they want to trick you, or unless they want to do something else. But the first company will always be the parent. So take the parent assets, the parent's liabilities, the parent's equity capital. Then you identify the subsidiary. The subsidiary, you take the subsidiary assets, add it to the parent own. Their liabilities, add it to the parent own. We don't consolidate the equity items of the subsidiary. Why? The parent investment, which is an asset, will be used to cancel the net asset of the subsidiary at acquisition. Then the difference over there will be treated as goodwill because the parent is supposed to be showing the investment in the subsidiary as an asset, and the subsidiary net asset, or which is the equity, will also be there. But since they are all relating to the same thing, we net the equity of the subsidiary against the amount that the parent is paying. So we take off the investment from the statement of the parent. Then we now what? We now have the difference, which we call the goodwill. Okay. Then you do your group structure. You do your net asset at acquisition as reporting because you want to know the profit after acquisition, which will be shared among the NCI and the parents. Then you know the NCI. What is the total value of the portion that the parent is not buying? What will be the value as at the end of the year? You do that. You do your goodwill. You do your group return earnings. What is the total return earnings of the parent at acquisition, at reporting? We do that. If there is any other component of equity of the parent, we also do that and move on. All right. That is basically the issue. But we are going to be picking questions to demonstrate whatever we are talking about. So don't worry, everything will be fine. Okay. Before anything, okay, before we even before we do anything, okay, let me talk about this, please. You cannot do group accounts. You cannot have a question in group account without the following issues. Okay, you cannot have a question in group account without the following issues. The first one is fair value adjustments. Okay, I hope we all have an idea about business valuation. Okay, if you come to business valuation, you can see that the holders of the what of the investee or the subsidiary, they are selling their shares. So if they want to sell their shares, they will have to know the value, the market value of the what of the investment that they are selling. So it's just like a business valuation. They will first of all value the business and sell it. So if you want to sell the asset now, if I want to sell 70%, okay, what is the value of the 70% currently, not based on their what? On the book value of the asset. So we value the what? The asset. It's just like business valuation. You value and know the value of the portion that they are selling. So we use what? Fair values. Use the market value of the what? Of the assets and the liabilities. So if I want to sell this particular asset in the market now, what is the value? It's just like business valuation. You value it before you sell. So we use fair values of the what? Both the assets and liabilities. And the question is going to be giving you what? Fair value adjustment. Because the net asset that you are going to be calculating will be based on book values. You'll be picking the figures from the statement of financial position, which is based on their carrying values. At the date of acquisition, at the time that you want to sell, the market value of the asset might not be the same as the carrying value. So if the value of the asset is increasing, liability will be constant. It means that the equity must increase based on accounting equation. The value of the asset is increasing. The equity must increase. So it means that your net asset will be increasing. This particular net asset, this particular fair value adjustment can be upwards or it can be what? It can be downwards. Okay. What it means is that the value of the asset can be increasing or reducing. And if these things are increasing or reducing, if it is going to be a depreciable asset, it means that there will be an issue of what? Depreciation there. You have an asset which have a value of, you have an asset which has a value of what? 10 million. Date of acquisition. They are now telling you that this value has increased at acquisition, has increased by 5 million. So if you are increasing this, it means that the value has to be 15 million, which will depreciate over what? Over the remaining useful life. But a subsidiary will not always incorporate this in their books, although the question can tell you that it will be incorporated. Okay. But a subsidiary in most cases will not be incorporated. The 5 million will not be incorporated. So they are charging depreciation on only the 10 million. Now we are bringing this value at acquisition date. It means that if you bringing this value at acquisition date, if we have acquired a subsidiary 2 years ago, it means that we have used 2 years out of this. So since you are having this at acquisition date, you are going to be using it now. So there will be an issue of what? Depreciation there. Fair value adjustment. Okay. Fair value adjustment. If it is a depreciable asset, there is going to be an issue of what? Depreciation. The depreciation can be additional depreciation or it can be excess depreciation, depending on the movement in the fair values. So we are going to be picking a question and demonstrate that. Okay. You can also have issue of deferred tax. Okay. Issue of deferred tax. Okay. Issue of deferred tax. Okay. Issue of deferred tax. You can also have an issue of deferred tax. Okay. We know that under IS 12, okay, under IS 12, we try to determine the what? the future tax implication of what transactions that are allowable for tax purposes that are happening today, but the entity is either enjoying or suffering, which is going to be presenting them a tax what a tax obligation or a tax consequences or tax benefit in the future. We try to determine the future implication of those things in today's term. And we know there is also a fair value adjustment. Whenever there is a revaluation of an item, there is going to be an issue where the carrying value of the asset will be higher than the tax base. So if the asset is 10 million, we assume that the asset is 10 million. The tax base is also 10 million at the date of acquisition. If the value of the asset, if you have now fair value the asset, you have revalued the asset, the value has increased by 5 million. It means that the carrying value of the asset will now be 15 million and the tax base will now be what? 10 million. So you are having a temporary difference of what? 5 million, which is going to be creating a deferred tax implication to you. So you can have either deferred tax liability or deferred tax asset. End of every year, you recalculate what? Your temporary difference and you do your deferred tax. We have a question that is going to be demonstrating that. Okay. You can also have an issue of what we call measurement period issues. Okay. Measurement. We have an issue of what we call measurement period issues. What do we mean by measurement period? Okay. We are saying that at the date of acquisition, all the assets should be fair valued. All the assets should be fair valued. Okay. There can be a situation where the parent will now employ a specialist to fair value the assets. But that particular value will not be readily determinable. So they will give you provisional values. So they'll say that, okay, we are finding it difficult to determine the value of this asset. But as of now, use this particular value for your consolidation purposes. So within a particular time, we now give you the actual value of the issues. The standard says that if the fair value of the asset, some of the assets cannot be readily determined at the acquisition date, the entity or the parent has a period of 1 year to determine that particular value. So if within a period of 1 year, the actual value has not been determined, we bring that particular value to the acquisition date as if it has been there at acquisition date. So they can say that because of the purpose of the fair value adjustment, the value is not readily determinable. So they have given a provisional value of 6 million to the entity. So let's say after 6 months, they have now determined that the value has increased by 4 million. You now add a 2 as 10 million. Okay, this particular value is determined for transaction that happened at acquisition date. So it means that the value of the asset at acquisition date should be 10 million. So you now treat the 10 million as what? As the value of the asset at acquisition date. So that's what we call the measurement period. You have 1 year to determine the fair value of all the assets. Any movement that will happen, which is as a result of what? The fair value that we are doing on that particular date, which is as a result of the fair value that we are doing at that particular date, will be captured as if it has been there at the beginning of the year. What again? You have to determine what we call, you have to now determine what we call there's an issue also of intra-group what? Trading, intra-group transactions. You have to pay attention to this. Intra-group transactions. The most common one is the trading among the what? Trading within the group. Trading within the group. Whether you are doing statement of financial position or statement of profit or loss. Yes, you cannot do consolidation without this particular footnote. So you have to understand this. If there is what? A group, intra-group transaction, what is going to happen? You cannot sell within yourself. It's just like you are giving an item to your friend to sell. And you wait till, but since the two of you are keeping records, you record this one in your books as sell. Your friend will also record it as purchases. But what will happen is that if your friend is able to sell all the goods, they'll bring the money back to you. It means that you have sold all the items. But if your friend is not able to sell all the items, he will bring some of them back to you. So you have to now recognize the amount of goods that has been sold by your friend as what? As the sell. It's just like you are sending goods to your branch. You cannot sell to your own branch. The branch is selling on behalf of what? On your behalf. So the parent is just selling to the subsidiary to a third party. So the parent cannot sell to the subsidiary. So the sale of the subsidiary or the parent becomes a sale for the group in whole. So you have to remove those intra-group transactions. Mostly it is the what? For statement of financial position, it is the profit element on the goods that are yet to be sold that is recognized in the books of the seller. that we normally remove. Okay, and other issues concerning that also. You can also look at transfer of PPE. Okay, transfer of PPE. You also have to take into consideration the issue of the transfer of PPE. Okay, we have looked at all these things when we are doing this one. So we just solve question. I saw a hand up. Yeah. Let me reserve the energy for.
Yeah, senior.
Yeah.
It's like we've reached capacity on the WhatsApp page. They are complaining that you should increase the capacity so that they'll be able to get.
Okay, what they have to know is that the meeting is recorded. For now, I can only take 100 people. So it's like that should be opportunity cost to them because what they were doing, we were not there with them. They were enjoying and we are here suffering. So
Okay, I just want to bring your attention to that. Thanks.
okay. All right, Sina, thank you. But for now, I can only take 100 people, so I cannot do anything about it right now. So you can post it on the page that the capacity for now is 100. So they should wait for some time, or they should be praying that some people should leave so that they can come in quickly. Yeah, Senior Frederick.
Boss, please. My problem is with the presentation.
Yeah.
You know, when you are doing the financial position and then maybe how do you call it? Let's say financial statements as a whole. You see,
Yeah.
the way you taught us when you are presenting, you can be doing the workings on the face of the financial statement.
Yeah.
I don't know. Initially, from my previous classes, I was told to do the workings background and make sure you present everything clear. So I don't know whether in exams you can present it the way you have taught us, and you will not be penalized for that.
What you have to know is that the examiner knows that you are doing this as an exam and you are working under time, isn't it?
Yes.
So there's no problem for this one. If you can present, that's why me I do my working, and I've never felt corporate reporting and financial reporting. So if they should penalize people for that, maybe I will not be here. Okay. But if you have the ability to do the workings first, for me, the reason
No,
why
it has always been wasting my time. Like, but anytime I write a paper, I see that during the working, come to write the same thing on the face of the financial position. It has always been wasting my time. I want to go by this approach. That's why I'm asking.
Yes, please. Nobody's going to penalize you.
Okay. And the second thing is with the writing of some of the items.
Abbreviations.
Yes, the abbreviation, the fair value. Do you have to write the fair value? The ACI, do you have to write the non-controlling?
NCI will be accepted. PP will be accepted. Some of them are widely, they are mostly used abbreviations. So NCI will be accepted, and PP will be accepted. But current assets, CA has a lot of abbreviations. So just write the current asset in full.
What's our fair value? They say the fair value of ACI.
No, just write fair. If you want to write FV, okay, you can write FV of NCI, but you can also drop a key that whenever the examiner sees FV, it means a fair value. So you can drop it. Okay, but you don't have to write like you are doing jargon. At least most of them should be in the but PPE, NCI, and the FV of NCI. The examiner will know that is a fair value of NCI. Okay. Those ones are accepted. But consolidate first. Just add the figures. Some of the figures you don't have to do workings before you bring them. So those ones bring them before. Maybe after the class I can share corporate reporting master marking scheme with us so that we look at how those issues are being addressed there. Okay.
Okay. All right.
All right. Thank you. All right. So let's pick some questions now. We have done a lot of the talking. So let's pick some questions now. Consolidation is 25 marks. Financial reporting standard is still 30 marks. Ethical framework and sustainability is 15 marks. So ethics will be like 5. The examiner has a choice to spread the marks. So ethics can be 5 or 10. Sustainability can be 5 or 10, depending on what the examiner is going to be doing. Specialized transaction is 15. We are going to be doing the standards tomorrow and the ratio and the specialized transaction on Friday. Okay, so it will be only in 3 days. Interpretation of financial statement is now 15 marks. Okay, consolidation, the first question, which will be question 1, will be 20 marks, and you will still have some 5 marks question under any or question 4 or whatever for also 5 marks. Okay, so let's pick this question and see what we can do. Okay, so we have to identify. Okay, from all the things that we have said so far, who will be the parent here?
Yamasi.
Okay, so what are we going to be doing? After seeing this, what do you have to do?
We set out the PP.
Okay, this question will still be what? Will still be statement of financial position, isn't it? Looking at it.
Yes.
Okay, so what do you have to do?
Yamasi would be the parents.
Okay, so we just have to come here and do Jamasi group. Don't you see some of the footnotes? If you look at it, okay, the English alone can confuse you. You don't know what to do. Okay, so just put your statement of Jamasi group. Okay, so you have your Jamasi group here. Then you have statement of financial position. Statement of financial position as at, you put a date there. Then you come here, you have their assets. So you have the assets. Okay, so you have the assets here. Then you have non-current assets. You have non-current assets. So we have the PPE there. Okay, what is the value of their PPE?
1.5 PP.
Okay, so we have 1.15 or 1.680.
1580.
1,500.
Okay, 1.580. Okay, so we have investment property there. Okay,
650.
650. So their investment over there is likely to be the parent investment in the subsidiary. But what you have to do is that at the end of the day, you have to reconcile the respective investment. You have to reconcile the investment that the parent is making. Okay, so we are going to be leaving, or we can write the investment there. If we reconcile, they are all zero, then we just come and put dash there. So we have to reconcile the amount that the parent is paying, which is included in investment, and see whether the parent is having other investment. You might be having goodwill to leave like 3 or 2 spaces over here. You might be having goodwill. You might have an investment in associate, depending on the nature of the question. So you can leave a space here, then you come to current assets. So the current asset.
Inventories.
Okay, we have inventories. The parent figure is what?
490.
490.
490. Okay.
Yeah.
So we have the parent figure to be 490. Then we
Other
come,
current assets.
okay, so we have the other current assets. You have to know that other current assets will be cash, receivables, and everything will be here, isn't it?
Yeah.
Okay. So we have, what is the parent figure?
360.
6.
360.
160.
Please, someone 360 or 860.
360.
Okay. So we have equity and liabilities. Equity and liabilities. So the equity should be that of the parent, because that of the
Yeah,
subsidiary will be
yeah.
cancelled with the what? With the investment that the parent is making. So their share capital is what?
1,400.
1,400.
1,400. So we have their retained earnings. So the equity
Amen.
items will be that of what? So now we go and do workings for that one.
Work.
Okay. Did they have other components of equity?
Other component of equity.
So we have other components of equity.
750.
So that one too, we'll be doing workings for that one. There might be some issues there, which we have to look at. So after that one, you have the NCI. Okay. Then you have your liabilities.
Liability.
So liabilities, you can have non-current liabilities, but this one, they are giving only one figure for the liabilities, isn't it?
Current is 450.
Oh, I'm sure the liabilities are only one. Liabilities.
Yes, it's one line,
Yes.
450.
Okay. So the parent is 450. Okay. After doing this, you just go and do your workings. Okay. So you have your workings over here. So you write your workings. Then you have working one, group structure. So the group structure, you don't have to determine that. You can just leave a space. Then where you are going to be putting the group structure, you leave a space. Then you come to, there's going to be a net asset. You want to know the profit that the parent is making or the subsidiary is making over the post-acquisition period, which will be shared among the NCI and the parent. So you come to the net asset over here, workings two, net asset. So the net asset you do at acquisition here, at acquisition and at reporting. You don't know the subsidiary yet, so leave a space and move on. So at reporting, the currency sign will be here. So you can leave a currency sign here and move on. Okay. Then there can be two, we have two different companies over there. So there can be two subsidiaries. So you can leave a space to what? To do the net asset for all the subsidiaries. Or you can do the workings anyhow. The one that you can do first, bring it. You can go and do net asset as the last workings. Nobody's going to penalize you. Okay. Nobody's going to do anything. So you don't have to do the workings in order. The group structure, you can do the group structure as the last one. The examiner will determine the group structure. Looking at the workings, he will go and see the group structure and give you ticks. It doesn't mean that group structure should always be the first one. You are working under what? Exam condition. So the one that you can do first, that is the one that you are going to be doing what? You can bring first. So it's not compulsory that bring the net asset first. No. All right. So we can leave whole of this place and go to goodwill now. So since there are two subsidiaries or there are two different companies, the two of them can be subsidiaries. So we need to have the goodwill also for the two. So we have goodwill calculation over here. So you can leave a space over there. You'll be having purchase consideration. So you can write purchase consideration and go to the footnote and determine that, okay, we might be having 2-1. So you have workings 4 over here to be NCI. The NCI too can be 2. So we leave it. We come to this particular side and we have our group return earnings. So the group return earnings, you can have the group return earnings here. So the group return earnings, you just start with the parent own. You can see the parent figure in the statement of financial position. What is the figure for the parent?
930.
Okay, 930. So you can actually bring that one first. Okay, so this one actually, this can be here. So you can have 6 over here to be other components of equity. The other component of equity, we are doing this for a parent. And you can see the parent figure in the statement of financial position. What is the parent's other component of equity?
750.
Okay, 750. Okay. After doing this now, you can now start with the what? With the footnote. You can adjust the footnote anyhow. You can start from the one that you can do. The one that you can do, adjust it. As soon as you are done with the adjustment, pass the entries. Pass the entries before you move on to the next one. If you want to do one by one, at the end of the day, you might what? You might not have some of the entries that you have done, or some of the figures that you have done, or some of the adjustment that you have done, and you will be passing the entries for them. But since we are solving a question, okay, we can start with the footnote 1. Footnote 1. Auntie Vic, are you there? Okay. She's not here.
Yes, please, I'm here. I'm here.
Okay. So footnote 1 for us.
Footnote 1. On 1st January 2022, Jamesi acquired 60% shareholdings in Agona at the following consideration, which has not been recorded in Jamesi's books.
Okay, so we know that we are having one subsidiary now, isn't it?
Yes, sir.
and that is
Yes.
Agona. So what we do is scan through the footnotes and see whether there is a disposal of Agona. Okay, is the parent going to be losing control over the subsidiary during this particular reporting period? You scan through. If there's no disposal, then it means that the subsidiary is going to be there up to today. So we can scan through to see there's no disposal of that particular subsidiary. There's no disposal. There is no disposal. Okay, there is no disposal. But don't be too excited and be adding. This one, I know which question is this one. That is why I'm saying that there is no disposal. But if you haven't seen the question before, check and see whether there is a disposal or not. Since there is no disposal now, this is a subsidiary. We have to consolidate the subsidiary. So what we have to do now is that we have to pick the figures of the subsidiary. So their assets and their liabilities. So their PP is what?
840.
So you go and add the
840.
PP to be 840.
40.
They don't have any investment property, isn't it? Okay.
Yes.
Yes.
So let's do the investment. Let's add the investment and come and what and come and reconcile it later. So we have 450 for the parents. Okay, we are going to reconcile that particular investment later. So 450. That of the subsidiary is how much?
170.
170.
170.
Okay. What is the value of their inventory?
Inventory 330.
330. Okay. Their other current assets.
260.
260. So their equity will not come. So let's come to their liabilities.
40. 240.
Someone should mention it again.
240.
Okay, 240. So you can see that we can identify group structure from that particular transaction, isn't it?
Yes, sir.
Yes, sir.
Please do the group structure in the table form. Okay. There is no format for doing the group structure. There is no format. Nobody should lie to you. There is no format. The only thing is that you show the respective holdings that the parent is having in the subsidiaries. So you can do the group structure in a tabular form. How do you do that particular one? This is what you are going to be doing. So you just have the name of the subsidiary one by one. So let's put a table here. So you have the table here. So what we do over here is you have the name of the subsidiary. So you have the Agona here. Okay. Then if we have a different one, we put it over there. So you put the parent here. So what is the parent holding here? 60%, isn't it?
Yes, sir.
Okay. NCL will be what?
40.
40.
NCL will be 40. So you have your acquisition date. Put your acquisition date here. Okay, acquisition date or date of acquisition. Okay, that was January 1, 2022, isn't it? So you have January 1, 2022 there, or 1st January 2022, anyhow you are writing it. So 1 January 2022. You have your reporting date. Okay, this page cannot help me. So my reporting date is what? What is the reporting date? The figure at the top of the, that is what?
30th June 2022.
Okay, 30th June. So you have 30th June 2020. Okay. So we cannot have the post-acquisition period because the table, but you have to bring the post-acquisition period there. Okay. You have to bring the post-acquisition period over there, but I don't have the space there. So you can do net asset for this particular subsidiary, isn't it?
Yes, sir.
Okay. So you come
Yes,
to the
sir.
net assets of this particular subsidiary. With that particular footnote, you cannot have net assets of Aguna. We are using the net asset is just the what? The shareholders fund. So we always use the equity side of it. So you have their share capital. Please, the share capital at acquisition will be the same as at reporting because we want the parent to have the same percentage of ownership. So if the subsidiary is having 17 million shares and you have acquired 60%, if they issue new shares, it means that there will be a dilution in your ownership. So we want you to have 60% from the date of acquisition to any day at all. So the share value of the subsidiary at acquisition will be the same as the share value at reporting. there's not going to be any new issue of shares. If there's new issue of shares, the parent is not going to be having the 60% again. So let's go to their share capital and bring that their value over here. So what is their value?
650.
650.
That will be 650. The question will either give you their retained earnings at acquisition, or they will say something there. So we have 650, that should be at reporting and at acquisition. So we bring their equity items. We have the retained earnings. So the retained earnings, the reporting figure is the one in the statement of financial position. How much is that?
510.
15.
Okay. So reporting, that is 30th June. That is the reporting figure, 510. So you pick that particular one. Then we'll be looking through to see whether the question will be telling us something about retained earnings for them at what? At acquisition. So let's
As
come,
acquisition.
let's do the next one. Do they have other component of equity?
Yes.
Yes.
At reporting is what?
At reporting is 200.
200.
Okay. But we don't know at acquisition. So we'll be reading through to see whether there is any acquisition. So you have done this now. You can move on to whatever they are going to be saying. So with that particular one statement, you have done so many things with that particular one statement. One by one, you are going and we are going. Let's take the purchase consideration that they are talking about now. Auntie Vic, are you gone?
I'm here, please. I'm not gone.
Okay.
One share in Jamesi was given for every 3 shares in Agona. The issue was made 3 months after Jamesi had acquired the shares in Agona. The share price of Jamesi's share and Agona share were 6 cedis and 2 Ghana cedis respectively at 1st January 2022. However, the share price
It's supposed to be Jamasi and this one. I have to modify that one.
Okay, however, the share price of Jamesi and Agona were 9 Ghana cedis and 3.2 cedis respectively at 31st March 2022.
Okay. So they are saying that these were the following considerations, but none of them has been recorded, isn't it? Okay.
Yes.
The first one is saying that they are saying that Jamasi is giving what? 1 share in what? In Acer for every 3 shares that they have acquired in Agona. So that is a share exchange. So what we have to do is that we have to determine the number of shares that have been acquired by Jamasi. They are telling us Jamasi has acquired what? 60% of the shareholding. So what will be the number of shares that Agona will be having based on the information that we have? What is the number of shares? Based on the information that we have, statement of financial position, what will be the number of shares for?
650.
That will be 650 million, isn't it? Okay.
Yes.
That is the value of the shares divided by 1, divided by the price of a share. That will be 660. But Jamasi is acquiring what? 60% of that.
2%.
Okay, so what will be the number of shares?
390.
Okay, 390, isn't it?
Yes, sir.
Okay. So this 390, we are settling these through a share exchange. We are saying that we will give you 1 share in our company for every 3 shares that we are acquiring in your company. So how many shares will be issued to the former shareholders of Agona using Jamasi shares? Jamasi is giving them 1 share for every share that they have acquired, every 3 shares that they have acquired. How many shares will be given to the shareholders of what? Of Agona?
130.
That will be 130. You just have to do 1/3 multiplied by the number of shares that the company is buying. 1/3 multiplied by the number of shares. Okay. But the question is, we don't want the number of shares that they are giving. We want the value of the shares that they are giving to them. Okay. We want the value of the shares that they are giving to them. So the question is this one. Okay. We have done something about this, but I just want to put it over here for some people who are not aware of it, although we have addressed this issue. Okay, last time we were solving question under disposal, we said that sometimes the share exchange, okay, acquisition can be done today and the shares will be given to what? To the former shareholders of the subsidiary at a later date. And they are going to be giving you two values, 2 market values. Which of them do we use? What did we say about that? acquisition will be done today, and the shares will be issued at 3 months' time, and it will give you value at today and the value in the 3 months' time, the value of the shares. Which of them did we say that we should use?
Value
So
at
we use
today.
At the
as
date
admin.
that the control was given.
Okay, we say that we should use the value at the date that what the control has been achieved. It means that the shares has been given to them, but they are saying that they don't need the shares now. So you give the shares to us in 3 months' time. So if acquisition is done today and the shares are going to be issued at a later date, you use the share value at the time that control has been what? Has been obtained.
Yeah.
So that will be first what? January. So if you want to know the number of shares now, the share exchange will be this figure. So we come to purchase consideration now. So we come to goodwill. The goodwill, we have the purchase consideration now. This goodwill will be for Agona. So we have the purchase consideration. Okay, the purchase consideration, let me just have, I'll put the two together as purchase consideration. Purchase consideration. That will be, we have a share exchange. So the share exchange will be 1/3 multiplied by 390 multiplied by the market value is how much? At acquisition will be what? I'm sure that is 6 cities.
60.
Okay.
Yes.
So we multiply by 6 cities. How much are we having?
780.
780. They say this has not been recorded. What should be the entry that we are going to be passing? What will be the entries that we have to pass? This has not been recorded. Okay. So we will be giving
Debit
this to the
investment.
shareholders and our investment will be increasing,
We
isn't it?
debit and we credit.
Yes, please.
Okay. We debit investment and credit what?
Equity.
The equity of the what?
Other component of equity.
No, this one is actually shares that we are giving to them. Okay. It's not options. We are giving them shares. Okay. But I've always said that you should assume that you are issuing the shares to the outsiders and you are using the cash to what? To pay for the shares that you are acquiring. So if you are giving the 780 shares, you are issuing it to outsiders. What will happen is that the outsiders will buy it and the equity will be increasing, the cash will be increasing. Then you will now use the cash to pay. If you use the cash to pay now, the cash will now be reducing and you are going to be having investment. So in fact, the cash is having a zero effect. So the entry will be, the first one to be debit cash, credit equity. Then you now use the cash to pay. So you now debit the investment and you credit cash now. Cash is having a zero balance. So the entry will always be debit investment and credit what? Equity of the parent. So that will come here. Please, the parent is not using existing shares. The shareholders, the former shareholders of the parent will still be there. And we are having additional shareholders. So the shares is increasing. Some people would think that the parent is using the 1,400. They are using part of the 1,400 to what? To buy that one. No. The former shareholders of the parent will still be there. And additional shareholders will be coming. It's just like you are issuing the shares to what? To new people now. You are issuing your shares to new people. They will buy and they will come. So it's an increase in the what? In the shareholding. So we debit the investment. The investment debit is the purchase consideration that we have over here. The purchase consideration is just the cost of the investment. So putting it over here means that we are debiting the investment. We credit equity. We are done with that particular one. Okay, let's move on to the next one. Auntie Vic.
Yes, please.
No.
Footnote 2. Additional consideration shall also be settled in fixed number of Jamesis equity shares 2 years later, provided that profit of Agona exceed a certain benchmark. The fair value of this conditional payment at acquisition date was estimated at 143 million cedis, which has increased to 150 million cedis on 30th June 2022.
Okay, this is what a contingent what consideration, isn't it? Okay, but you have to establish whether it's equity. We have contingent consideration that can be equity and contingent consideration that can be a liability. Okay, let's talk about this one before we move on. The question will be telling you that this will be settled in a variable number of what? Shares for. Okay. The question can tell you that this consideration will be settled in a variable number of shares for what? For the variable number of shares of the parent. Variable means that if the shares is increasing, the consideration will also be increasing. But this is a fixed number of what? This is a fixed number of what? A fixed number of shares. Whether you like it or not, the shares will be 2 million or it will be 20,000. So this is a contingent consideration that will be settled in equity. Okay, that will be settled in equity. If they say a variable number of shares, variable means that the value will increase if the share increases. If we are setting the price to be, let's say, 20 cedis, and we are saying that we are going to be settling you at 20 cedis, but it will be based on variable number of shares. It means that if the share increases, the value will increase. So if it's variable number of shares, that particular instrument will be treated as equity, will be treated as a liability instrument, or a financial liability, or a liability instrument, or a debt instrument. It means that if we are paying you 20 cedis per share, and we are saying a variable number of shares, it means that if the share increases, the amount will also increase. So in that case, the value will be increasing. We are going to be fair valuing the value at every reporting date. That will be treated as a debt instrument. But if we are going to be paying you 20 cedis per share, and that is going to be a fixed number of shares, which is 20,000, it means that at any date, it will be 20,000 multiplied by 20. So this is what? A contingent in the equity that will be settled in the what? In equity. That will be settled in equity. So what will happen over here is that this particular consideration will be treated as a contingent consideration, but it will be treated as equity because they are going to be giving them equity shares. And what we do about equity shares is that equity instruments, once it is recognized, we cannot remeasure it. That is why you see equity value in the statement of what? A company. If the equity is 10,000, there is no way they are going to be saying that the equity, the fair value of the equity now is 120,000. So let's put 120,000 there. No, equity once recognized cannot be remeasured. It's not liability. So this will be treated as equity, but we are here to give them the shares. So we take it to other components of equity. And then that will be at 143. We are not going to remeasure it. It will just be 143, and we are not going to remeasure it. So this will be a contingent consideration that will be added to our purchase consideration. So we have a contingent consideration that is going to be settled in the equity, and that will be 143. So this one, it has not been recognized. So we go to other components of equity, and we bring the contingent consideration here to be 143. Please pay attention to the footnotes. You might go to the exam and see some of the footnotes there. So we don't remeasure this one. So forget about the 150 that they are giving to you. Okay, we don't do anything about this particular one. Let's come to the B. Auntie Vic, if you're not going to
B.
cooperate with us, you can tell us so that we can find a replacement.
B. At acquisition date, Agona's retained earnings were 300 million cedis. Other
Hello,
component
sir.
of equity
Yeah.
I have a
was
question.
Okay.
Please, when we're doing the fair value of the additional consideration, I don't know why we have not used the 150, but
the consideration is going to be settled in equity shares, which is a fixed number of equity shares. So if we are giving you 20,000 shares, it means that it will be 20,000 shares. It's not going to be increasing, and the value will still be 20.
okay.
It will, if it is a liability and they say it will be settled in a variable number of shares, then you fair value. If it is a liability, we fair value liability. By equity, we don't fair value equity after it has been recognized.
Okay.
All right. Auntie Vic, can you take that
B.
one? Yeah.
Yes, please. At acquisition date, Agona's retained earnings were 300 million cedis. Other component of equity was 120 million cedis. And fair value of NCI was 340 million cedis. The carrying value of Agona's net assets were equal to their fair values, except the following.
Oh, stop there.
One.
of the,
Okay.
we can see that that particular, the B1 over there, up to the end of the following, we can see that we have three entries over there to pass, isn't it?
Yes, sir.
Okay. So we have the retained
Yes.
earnings at what? At acquisition, isn't it?
Yes, sir.
Yes.
Okay. Okay. So we have the NCI. So we have the fair value of the NCI at acquisition. That was 340, isn't it?
Yes, please.
Okay. So we come to the retained earnings at acquisition was 300. Okay. And this was like
Yes.
120. Okay. This was 120. So we have done that now. We can now move on. Okay, we can also pass the what? The fourth entry. The fourth entry will be, we'll add the NCI to what? To add this one to know the total value when we are calculating the goodwill. So we can add this one now, and you will have the total for that. Let's have the total for that and move on. 780 plus 140 plus 340. I'm having 1263. Okay. So,
That's three.
okay, pick that one for us now. Okay. A property and plant. Okay.
Yeah, a property, plant, and equipment was carried at 50 million cedis. This PP had a fair value estimated at 18 million cedis. The remaining useful life of this PP was 5 years at the acquisition date.
Okay. The question will always tell you that this fair value adjustment has not been incorporated. But if nothing has been said about it, it means that this fair value adjustment has not been incorporated. So in the books of what? In the books of Agona, the PP is carried at 50 million, isn't it? Okay.
Yes, sir.
And the net asset that we are using over here, the net asset that we have over them over here is based on their carrying value. So it means that we use only the 50 to calculate this. But at acquisition date, they are saying that that is now going to be how much?
80,
80,
And so it has increased by what?
30.
30.
It has increased by 30. So the entry that we are going to be passing is that this is just like a revaluation. So this is just like a revaluation. What we are going to be doing is that you debit, your asset value will increase and your revaluation will also increase. And the revaluation is included in what? In the net assets. So what we do is that you debit the asset by the increment at acquisition date. So you come over here and add 30. You go to your revaluation, also credit the revaluation because it will be increasing. So you come to the PP over here, and that will be increased by 30. Okay, the 30 over here, which is including the revaluation surplus, will still be taken to the reporting. So the revaluation at acquisition will still be taken to reporting. So it means I will still bring the 30 over here. Okay, but the question is this particular asset a depreciable asset?
Yes.
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 Okay, this asset is a depreciable asset, isn't it?
Yeah.
Okay.
Yes.
This fair value movement was incorporated in the books of the subsidiary at the beginning or at the acquisition date, which is 1st January, isn't it?
Acquisition date.
Which is 1st January 2022,
Yeah.
isn't it? Okay.
Yes, sir.
Yes.
When are we preparing the statement?
At the year end.
Which is
Yeah.
30th June, 6
No,
months after
30th
that one.
June,
6
6 months.
months after. Would the value of that particular asset still be 30 million?
No.
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 It will not be the same, isn't it? Okay. Because the asset is what? It's a depreciable asset, which is having 5 years. So from the acquisition date, the asset is having 5 years. We have used it for 6 months. So the value will now be 4 years and 6 months. So we have to calculate depreciation. The meaning is that we are now doing this as if the asset has been there at 1st January 2022. If the asset was to be there, it means that we are going to be using it for what? For 6 months. And if we use it for 6 months, that depreciation will be taken from the profit of the what? Of the subsidiary. But that has not been done because the subsidiary has not incorporated this particular adjustment in the what? In the financial statement. So since we are bringing the assets at 1st January, it means that we are going to be using it for 6 months. So we calculate a depreciation for 6 months. And that depreciation should be taken from the profit. That will be after from January to June. the profit that is made over the depreciation will be taken away from that. So we have 30 now divided by 5 multiplied by 6 over 12. What are we having?
3.
And that 3 will be taken away from the profit at what? At the profit is included at reporting. The difference between the retained earnings at acquisition and at reporting is the profit, and the profit is at reporting. So we take it away from it. What will happen to the assets? We are keeping the assets as 30 million. The value of the assets should have been what? 27 million, isn't it?
Yes, please.
Okay. So the entry that we are going to be passing for the depreciation is to debit profit or loss. If it is profit or loss, we add it to cost of sales, and we reduce the value of the assets because we are still carrying the assets in our books at what? At 30. So we remove that particular one. There might be deferred tax adjustment. We go there. If there's a deferred tax adjustment, then we come and pass the deferred tax adjustment for this particular one and actually move on. All right. The second part.
Fair value of property, plant and equipment. Okay, it's the same thing. Fair value of property, plant and equipment that Agona at acquisition had made a decision to sell. We did not change despite the acquisition was 35 million cedis, but the historical cost carrying value was 15 million cedis. The estimated selling cost of the asset on this date was 1 million cedis. The asset was yet to be sold as at 30th June 2022, and the above Agona's financial statement is here to reflect the decision to sell the asset and any fair value adjustment. The group follows cost model for subsequent measurement of all property, plant, and equipment. The group deems any fair value adjustment at temporary difference. The appropriate tax rate for tax adjustment is 25%.
Okay, but let's tackle the fair value. Okay, last time that we were doing the intro to consolidation, we said that if you come to fair value adjustments, all liabilities and assets should be fair value. But we have some exceptions, isn't it? And we say that the exception is the first one is assets held for sale. If at acquisition date they are talking about asset held for sale, you use the applicable standard, which is the IFRS 5, to account for that. Issue of deferred tax also, we use the IAS 12 to also account for that. Please, what if the depreciation is added in the net asset? This one, we are not going to be adding the depreciation. Okay, we are not adding. Okay, if the question says that this has been incorporated already, this fair value adjustment has been incorporated already, then you just do the what? You just pass the entry for acquisition. So you just bring the 30 for acquisition. It means that they have already done this for reporting already. So the depreciation has been taken from that one. But this particular one, nothing has been said. So it is assumed that that particular has not been incorporated. So the excess depreciation, the additional depreciation will be taken from cost of sales, will be added to cost of sales and be taken from net asset. And I'm saying that if you are doing only statement of profit or loss, you add it to cost of sales. But if you are doing both, you add it to cost of sales and you still take it from asset at reporting, because net asset at reporting, you are looking for profit again. So that will be having the same effect. Okay, I don't know whether you are cool there. So we are saying that some of the standards, some of the adjustments at acquisition, the fair value should be measured, making reference to the specific standards that are actually regulating those particular items at acquisition. The first one is non-current asset held for sale. If there's an issue at acquisition, they are talking about non-current asset held for sale. You use what? You use IFRS 5 to determine that. If there is an issue of contingent asset and contingent liability, we use IAS 37 to determine whether provision should be made at acquisition date. However, contingent liability should be recognized, even if it is not possible, as far as the fair value can be estimated at acquisition date. Recognize the contingent liability. However, contingent asset is never what? Recognized. Contingent asset is never recognized. They can give you some of the items, and if you put it together, you are going to mess up what? All the figures that you are going to be sending there. They will give you some of the items. If you don't know, you touch them. You don't know how to treat them. You touch them. It is going to mess up everything. Okay. So we also have deferred tax. We also have share-based payments, employees' benefits. If there is any issue relating to this one at acquisition, please use their respective standards. Don't just fair value them. Use their respective standards to determine that. Something we call indemnified assets. Sometimes they will say that these people are not making profit. So if your losses continue like this, you are going to pay back part of what? The consideration that has been given to you. You determine whether the consideration is likely to be paid back. If that is the case, then the parent will treat that as what? As a contingent asset, which we call the indemnified asset. It means that you are going to compensate the person back for a particular thing. Okay, let's come to this place. This is non-current asset held for sale. Okay, this is non-current asset held for sale. Okay, this one, we don't just fair value it. We use the IFRS 5 to what? To determine what? To determine the value that we are going to be recognizing at acquisition date. Okay, we are saying that entity cannot just stand up and say they want to sell an asset. It might happen that the asset is now useless. If the asset is useless, it means that the benefit that the asset is going to be given to them will be lower than the what? The original benefit that they are estimating, or the asset has involved in accidents. So whatever be the case, the reason for the sale of the asset is a possible indicator of impairment. So before you classify the asset, look for what? Look for or carry out impairment tests on the asset. So let's come here. How do we carry out impairment test? Impairment test is the carrying value against the what? The expected benefit, or the expected benefit from the continual use or from the sale of the asset in its present condition. But this is held for sale. We cannot get value in use because we are not going to continue using this asset. We want to sell it. So we get a value from sale. Okay, so let's take the carrying value of this particular asset. What is the carrying value of this particular asset based on the question?
50 million.
50 million.
Okay, so recoverable amount over here will just be the net realizable value, isn't it?
Yes, sir.
Yes.
Okay, net realizable value will be what? 35 minus 1.
35.
Minus 1. The cost to sell is what? 1. So that will be 34, isn't it?
Yes, sir.
Is there any
Yeah.
impairment on this asset?
No.
No.
So the asset will be carried at what? 15 million, isn't it?
Yes, sir.
So please, the asset is carried under cost model. So we don't fair value asset under cost model. If it should be under revaluation model, then we bring the asset to 34 million. We revalue. But the asset is carried under cost model. The group follows what? Cost model. So they are using cost model. We carry the asset, or we classify the asset at the lower of cost and the net realizable value. So the carrying value is lower. It means that the entity is supposed not to do any entry because the asset is already carried in their books at 15 million. So it means that the 15 million is already included in the net assets, and that is the correct amount. It was this footnote that they have taken and they modify it under the last sitting question that the last sitting, the July question. Okay, but they brought the net realizable value to be lower, so you have to bring the asset down to the net realizable value. But the 15 million is the carrying value, which is already included in the books of the entity, and the asset should be carried at what? The 15 million. So there's no entry that we have to pass over here. But what we have to do is that we have to go and classify the asset as held for sale. It's not going to be a non-current asset again because we are going to be selling this asset. So we have to now classify it as what? As a current asset. That is the only entry that we are going to be doing. So we go to our PP, we take the 15 from the PP and now classify the 15 as held for sale. Okay, so we come here and have minus 15, and we have this one to be held for sale. So non-current assets held for sale. That will give us 15. Okay, there's no other issue there. So we put a 15 over here. That is the only entry that you are passing. Don't fair value. If you come to certain issues, maybe I have to capture that side of the words of the standard, the IFRS 3, and share with you. If you come to certain issues. You use their specific standards, and the non-current asset held for sale is one of them. Okay, so there is no issue about that one because the asset is still carried at 50 million. So no fair value adjustment on that particular one. The only entry that is to remove the asset from that area and bring it to current asset as held for sale. That is all. The group deems any fair value adjustments as temporary difference. The appropriate tax rate for tax adjustment is 25%. Which of these adjustments is going to be affected by deferred tax or is going to be bringing issues of deferred tax? Which of these adjustments? Which of these adjustments is going to be bringing issues of deferred tax? Okay, let me take the first one. In the books of the entity, the asset for the first one was 50 million, isn't it?
Yeah.
Yes. Yeah.
Okay. If the tax base is the same as 50 million, the asset has now been revalued to 80 million at acquisition date, isn't it?
Yeah.
Yes, sir.
Okay. Tax authority, they don't know what we call what. The tax authority has no idea about what we call revaluation. So the asset will still be carried in their books at what? At 50 million. But in our books, it's now 80 million. So what is happening there? The carrying value will be higher than the tax base by 30 million, isn't it?
Yeah.
Yes, sir.
Revaluation will always bring in issues of what? Deferred tax. So at acquisition, we have to have a deferred tax liability there, which will be, so we have a deferred tax liability there at acquisition. So you calculate your temporary difference. Let me have a space for that one at acquisition. So at acquisition, which is at January 1, 2022, at January 1, 2022, our temporary difference, okay, our temporary difference will be calculated as a carrying value, which is now 80 million against the tax base. Assuming the tax base is same as the 50 million, okay, that will now give us what? 30 million. So at acquisition, the 30 million is the temporary difference. 25% on that, what are we having?
7.5.
7.5.
Okay, 7.5, isn't it?
Yes, please.
Okay, that will be a reduction. Okay, deferred tax liability. But at reporting, what will be the value of the assets now? At reporting, what is the carrying value of the asset? That is 30 million. At reporting, what will be the carrying value of the same asset? At reporting, this particular difference will now be what? It will now reduce by 3 million because we have used 3 million out of the asset. We are charged a depreciation of what? 3
Depreciation,
million.
yeah.
So the
Yeah.
asset will now be having 27 million, isn't it?
27 million, yeah.
So at that particular date, the temporary difference has now reduced to 27 million. The temporary difference has now reduced to 37 million. So if you want to do it over here, at the reporting date, which is 30th June, at the reporting date, that is 30th June 2022, assuming the carrying value and those one, maybe the tax authority is charging the same depreciation. This is what's going to happen. Our carrying value, we are only looking for the impact of the fair value adjustment. Our carrying value will now be 77, and our tax base will now be what? 50. Okay, this will now be 27. I'm saying that we are only looking for the impact of the fair value adjustment. Our temporary difference will now be 27. Deferred tax at the reporting date will now be 0.25 multiplied by 27. What are we having?
75. 6.75.
Okay, so that will give us 6.75. So deferred tax was 7.5, now reduced to what? 6.75. So at reporting, your deferred tax that you should be showing in your statement of financial position should be 6.75. You can see that there is a movement in the deferred tax, which is now a reduction. Deferred tax is treated as a provision. So if you are doing statement of profit or loss, this movement of deferred tax will be subtracted from the tax figure in the statement of financial position because 7.5 reduced to 6.75. That is a reduction in provision. But we are doing this one, so we just show that figure. You come here, you have your deferred tax over here, you add 6.75 here, because that should be the deferred tax as a what? As a closing balance, 6.75. Or someone can bring 7.5 at acquisition, then the person will now find the difference and subtract it and now bring it to 6.75. Any of them is cool. So that is the issue of deferred tax on the fair value adjustment. We have done it in class, but I just want to talk about it again. There cannot be, for corporate reporting, there cannot be fair value adjustment where they will not be talking about issues of deferred tax. Okay, so you have to master it very well. At acquisition date, what is the value? Calculate the deferred tax. Whenever there's a revaluation, the revaluation will automatically increase the what? The carrying value by the revaluation surplus, like how we do revaluation of what? Of PP, how we do deferred tax on a revaluation, the same thing. So at acquisition, what should be the temporary difference? The temporary difference is the same as the fair value adjustment. If the fair value adjustment is a reduction, that would be a deferred tax asset to you. So you calculate you have a deferred tax asset. It is an increase, that is a deferred tax liability. So at reporting, you ask yourself, what is the carrying value? Then you recalculate your deferred tax.
Hello, sir.
Yes, ma'am.
Please, I was a bit confused. I don't know how we got from the 80 was okay, but from the reporting to a figure of 77, you made mention of some trade test. Is it trade that we have to deduct from?
We have depreciated that asset by 3 million already. I hope you can remember the depreciation charge on that 6 months.
Yes.
So it means that depreciation will be taken from the asset
Okay,
is
will
now
be taken out of.
Yes. Please.
Okay.
Okay. All right. Auntie Vic.
Hello, Senior.
Yes, please.
Can you throw more light on the asset was yet to be sold as at 30th June 2022? And the Agona financial statement is yet to reflect the decision to sell the asset.
Okay.
And fair value adjustment.
Okay. So they said the asset was yet to be sold. Okay, we said that the reclassification, if you are classifying the asset as held for sale, the sale should be within 12 months, isn't it?
Okay.
So that is 6 months. So they will still classify the asset as held for sale.
Okay.
But what will happen is that one that they are saying that the asset was yet to be sold at and above Agona financial statement is yet to reflect the decision to sell the asset. The asset is in their PPE. So if they are making a decision to sell it, it means that the asset should be classified as held for sale, isn't it?
Okay.
Okay. You only fair value the asset when they are using what? Revaluation model.
I'm with you.
Held for sale is basically all the assets, all the standards, all the non-current asset standards are for the default method, which you call the cost model. All the non-current asset standards, impairment and all those things are for asset carry under cost model. So this asset is carried under cost model. Even if the net valuable value is higher, we don't fair value. Okay. The asset is carried under cost model. We are only looking for impairment. If there is no impairment, the asset should be carried at what? The carrying value. We don't fair value. So that 34 million, just forget about it and move on. The asset should be at the lower of what? The carrying value or the net valuable value. That is it.
I'm with you now.
Okay.
Hello, sir.
Yes, please.
Please, the deferred tax at the reporting.
Yeah.
Why didn't we apportion it?
On which one?
For the 6.75 for 6 months.
No, for the deferred tax, it will start from the acquisition date, so we don't do anything.
Oh, okay.
So it's not a full year thing. It will start. That is the deferred tax from the acquisition date.
Okay.
All right.
Thank you.
I saw another hand up. Yeah, Nana Yao.
Senior.
Yes, please.
So does it mean that the deferred tax will not affect the current assets?
The deferred tax
Hence,
will not.
the amount has been classified as assets held for sale. So the deferred tax will not affect that one.
No,
Rather go to
that one, the asset held for sale, there is no difference over there. You
Okay.
can say there's no movement, there's no fair value movement over there. So it means that the carrying value and the tax base, we assume that they are the same.
Okay.
Okay, if there should be a fair value movement over there, then that will create what? A deferred tax issues.
I'm with you.
Okay, we are doing it for the first asset, which is the 50 against 80. So please master the deferred tax very well and the fair value adjustments. And also intra-group trading, it can also be a transfer of whatever. Okay, so if we are not able to solve more questions, at least the explanation and everything can help us to. Please, why did we use 80 instead of 50 for the English? Okay.
You know what?
A property, plant, and equipment PP was carried at 50. The asset was carried at 50. This PP had a fair value estimated at 80 million. So in the books already, they have 50 there. And they are saying that the acquisition there is now 80. So you have 50 already. You just add the 30 to make it what? 80. So the 50 is already in the books. That is a carrying value. The 50 is already in the books. So how much we have to add to make it 80? It is what? 30. So we go and increase the value of the asset by the 30 there. Okay. I hope we don't have any listing for me, any queries for me again. If there's no issue, let's continue. Let's be moving. So I will solve complex group structure, step acquisition, and this one. I don't think I can do the cash flow and those ones. Okay. The cash flow, if I start right now, problem will come. So it is okay. Let's move on. Let's move on.
Footnote C.
Yeah.
Before the acquisition of Agona, Jamesi had acquired 280 million shares of Mount Porten on 1st July 2020 at a cash consideration of 450 million cedis.
Okay, stop there. Stop there.
Okay.
So let's check. Let's check whether Jamasi is having what? Is having control. They are buying 280 out of the total shares. So let's go and check that. Okay. Let's go and check there whether they are having what. So they are buying 280 out of the 400 million shares, isn't it? 280 out of the 400 million shares. So what is the control? What is the percentage of control there?
70%.
Okay. After establishing this, what do we do?
You go and consolidate, add them.
Okay. So let's come to group structure. Parent will now be 70%, isn't it? NCL will now be 30%. So we come there and do this one. This will be 1.10 here. Okay. So we have, so let's come to their, what is the value of their PPE?
580.
580.
Okay. Do they have investment property?
No.
Do they have investments?
Yes.
The investment
Yes,
is how much?
180.
Okay.
180.
Come here. How much is the parent paying for the shares there? The parent is paying 450. So you can see, look at this 450. You can see that the 450 over here is the investment in what? In the Maponchen. So we have to come and subtract that. Okay. So that will be taken away. So we reconcile it because it will be counted against the equity value of those people. So their inventory is what?
Hello.
Yeah.
Now, who was the
Who is that? Inventory is what?
Inventory 200.
Okay, inventory is 200. So we go to their other current assets.
None.
They don't have.
They don't have. Okay. So we go to their liabilities. What is their liabilities?
180. 180.
Okay, 180.
Hello, sir.
Yes, please.
Yeah, please, can you go over the investment side?
Okay, the investment over there. Okay, you can see that we have investment. Jamasi is having investment of what? Of 450. The investments, most at times the investment under the parent will always be the investment that the parent is making in the subsidiary. The parent will treat that as what? As an asset. Okay, so the 450 over here is basically to what? To the amount that they are paying for the shares in Jamasi, which is a 450. Okay, so what we do over here is this. Okay, so we come over here, that is 450. But what we have to do is, this is what we are going to be doing under normal circumstance. Okay, Under normal circumstance, the parents will be having 450 over here, and we'll be adding the equity items of Jamasi also. Okay, because if we are consolidating them, we add a parent figure and then a subsidiary figure. So we should have been adding this figure. Let's come here. The share capital of Jamasi should have been plus 200 here. Their retained earnings at acquisition is what? Let's go to their retained earnings at acquisition. Okay, so let me explain this one once and for all. Their retained earnings is 185, isn't it? The Mapontin is 185, and the other component of equity is what?
It's 30 million.
It's 30 million. Do they have NCI? Can we see the value of the NCI? Okay, Jamasi measures that this one at fair value by non-controlling interest in Mapontin at a proportionate share of net assets. So let's come here. Okay, at acquisition, this is the entries that the parents will be doing. Okay, at acquisition, these are the entries that the parents will be doing. Okay, let's come here. So the parent will be having a 450 in each books. Then the parent will be adding 200 of the subsidiary figure, which is the capital, the share capital at acquisition. Then 185 will be added to the parent figure, will be added to the retained earnings. Then 30 will now be added to what? The 30 will now be added to these are all at acquisition. What is the total figure?
$415.
Okay, 415. So 415, the parents will be having what? So it means that this will be shared. NCI will be having 30, isn't it? And the parent will be having what? 70. What is the value the parent is having? That is 290.5, isn't it?
Yes, sir.
Okay. Okay. This 290. Okay. This 290. The parent is paying 450 for the 290, isn't it? The parent is paying the 450 for the 290 in this particular situation.
Yes, sir. Yes, sir.
This is treated as an asset, and this will be treated as just like a liability, equity. So what we do is that, okay, since we are having the asset,
Oh, what can 1721? Come on.
Okay, this is just like intra-group balance. The parent is saying that they are having 450. The subsidiary is owing them 450. The subsidiary is also saying that the parent is having 290 with them. Okay, so this is relating to just a single transaction. So this is an asset. This is what this equity. So what we do over here is that let's just net the two. Let's net the two. If you net the two, what is the difference?
$159.5.
Okay, so you can see that the asset will still be 159 of the asset will be remaining after the netting, isn't it?
Hello, sir.
Yes, sir.
And this is what we call the goodwill. Okay, so what we do is that this particular investment will cancel the net asset. Under normal circumstance, the parents are supposed to be adding the equity items of the subsidiary, and the parents will be having the amount that they are paying. But since they are the same transaction, they are treated as a group, intra-group balances. So we cancel it and bring the difference as a goodwill. And the remaining portion will be treated as the NCI because the total value should be 415. We are now taking 290 from this one. So the remaining over here, that is what we treat as the NCI. So the parent portion will be net against the parent investment. Then we have the remaining figure to be the goodwill. Okay, so this is the reason we don't consolidate the equity items, because the equity items will be net against the parent amount that they are paying, and the difference will be treated as as a goodwill. And the remaining portion of the 30%, that is what we are having as the NCI. The parent is not buying that, so we cannot net that particular amount against the amount that the parent is paying. So that will be treated as NCI. Portion of the equity, that's what we treat as an NCI. Sin, I hope you're okay now. Can I move on with the 450? So we are removing
Yes,
the
sir.
450.
Thank you, sir.
From that particular one. Okay. Let's come to this particular one. Yeah. Someone mentioned my name. I don't know whether you are okay now. Okay. So this is just an example for this one. Let's come to this particular issue now. So we can have this one. Okay. So since we know that there is a control over here, we have consolidated their figures already. What we have to do is to draw the net asset table for these people now. We have to draw their net asset table. So let's come to the net asset table. I can actually show you how to do the net asset table for two subsidiaries. I will show that one at the end figure. So you just write the net asset. So you write the name of the two subsidiaries. So that if you have a share capital, you will not write a share capital two times. So you can put Maponten over here and have their net assets. So if you have the share capital, you put it over here. You come to Maponten and also put their net asset figure over here. Like that. You can combine the two. Okay. But if the combination will not work for you, fine, you can do it one by one. So we have the net assets, and that will be the Maponten. We have acquisition, and we have reporting. So let's have their currency sign here. Okay. Their share capital at acquisition will be the same as at reporting. That will be 200, 200. Their retained earnings will be 185, and their other component of equity will be 30.
Their share capital is 400. It is 400, not 200, please.
Not 200.
Hey, really?
Yes, please.
Okay, no problem. Okay. So 400. So we have 400 and 400. Okay, so what is their retained earnings at reporting and other component of equity at reporting?
Retained earnings 300.
Is how much now?
Reporting 300, retained.
Okay.
300.
Other component of equity?
80.
80. Okay. So we have done that now. We can now look at the other issues now. Antivik, you can take that for us now.
Okay. On acquisition date, Mampontin's retained earnings were 185 million cedis, and the other component of equity was 30 million cedis. Fair value of Mampontin's net assets was equal to their carrying value, except contingent assets and contingent liabilities disclosed in the financial statement of Mampontin at acquisition date, which had a fair value of 20 million and 25 million cedis respectively. It is assessed that the probability of payment in relation to the contingent liability is more likely than not as at 31st December 2020. The fair value of the liability at 31st December 2020 was 35 million cedis. The above financial statement of Mampontin excludes the effect of the contingent liabilities and contingent assets.
Okay, so we said that if you are doing fair value adjustments, one of the issues that you have to now use a standard, a particular standard to determine its fair value at acquisition date is a contingent asset and contingent liability. You use 37. Okay, let's come here. I'm saying that whatever be the case, contingent assets should not be recognized. Because if you come to 37, whether it is likely possible that the amount to be received, we don't recognize contingent assets. We only disclose if it is highly possible. Okay, but for the contingent liability, even if the question is not telling you that it is highly possible, if the parent can estimate the fair value, recognize it. But this one, they are telling us something over here. They are saying that it is assessed that the probability of payment in relation to the contingent liability is more likely than not. It means that the payment is more likely than we are not going to be paid. Okay, as at what? 31 December 2020. So we are going to be paying this as at 21 December 2020. So what do we have to do? We have to make provision for it as at today. Even if this is not added, please, if the contingent liability, the parent can determine the fair value for it or the estimated fair value at acquisition date, please recognize it. That is what the standard is saying for contingent liability. But for contingent asset, whatever be the case, under 37, we don't recognize it. It's only reimbursement that we recognize. that the person will be telling you that any amount that you have incurred as a result of the damages, we are going to be reimbursing you, we are going to be paying that particular amount. That is, if you incur expense, you recognize a counter refund as an asset. But apart from that one, we don't recognize what? A contingent asset, whether it is possible. Only contingent liability. If the fair value can be estimated at acquisition date, recognize it. If they are not saying anything about it being probable to be paid. But this one, they are making it specific that at acquisition date, it is determined that the probability of paying it is more likely than not. The more likely than not is that the probability that you are going to be passing is more likely than you are not going to be passing. That's what they are saying. So the probability of you passing is more than you not passing. So it means that you are going to be passing and you are going to be paying. That is the meaning. So we have to bring in the contingent liability into the books. Ignore the contingent asset. Whatever be the case, we don't recognize contingent assets under IAS 37. So we go to this one. They are saying that the above financial statement excludes the effect of the contingent liabilities and the contingent assets. If you don't take time and you include the contingent assets, it means that your post-acquisition profit is wrong, your retained earnings figure will be wrong, your NCL will be wrong, your goodwill will be wrong. So don't force yourself to add those figures. If you are not sure of the adjustments that you are doing, please, the figures that you are sure of, add them and go and put them in the statement of financial position and get your ticks. Those that you are not sure, if you are not sure of the retained earnings, please don't add. Because if you add, you are not going to be getting any ticks. They are going to run that figure in the statement of financial position. You have wasted time for no result. So if you know that you are not sure, please just go to the statement of financial position. Just write any figure for the retained earnings. Don't even waste time to add because you are not sure of the adjustment. It's only one tick that you are going to be getting for that figure. So if you are not sure, don't add. Just go and write an assumed figure over there so that they will not say that you have left the financial statement open, although you can leave it open. It's not a work that you are doing for your boss at the workplace. No, it's an exam. They will mark the ticks one, they will mark the figures that you have put in brackets one by one. So if you are not sure, don't even think about adding the net assets because you are going to be adding for no marks and you are wasting time. Go and use that particular time on something that you think you can do proper. Okay, it's not all the footnotes that you have to adjust. It's not possible. Just do the ones that you can do. Do them well and move on to another one. It's 15 marks. Those who want to get that will leave them. It's 15 marks. They are all going to be 15 marks. Pass. All right. So let's bring the contingent liability. This has not been captured in the books. So it means that the net asset that they have is excluding the contingent liability. They don't have the contingent liability in their books. So it means that these things that they are having over here is excluding the contingent liability. So net asset is determined as total asset minus what? Total liabilities if you count to consolidation. So it means that the liability should be taken from this figure. Liability is going to be reducing our assets. So we come here, we have our contingent liability of how much at acquisition?
$25 million.
25 million. Okay, reporting is what? Reporting is how much?
35.
Okay. So this is the liability with fair value liability. Okay, liability is fair value at the end of every year. So you have 25, 35. So in the statement of financial position, you now come and add your liability that you'll be having as a contingent liability should be 35. That's all. If you don't take time and you bring in the issue of what? Contingent asset, you have spoiled everything.
Take a look at the date soon.
Okay, you have spoiled everything. Okay, contingent asset, I'll say it again. Whether it is possible or it is not possible, please, under IAS 37, we don't recognize contingent asset. The best that we can do is to disclose. But however, if it is a reimbursement where you are telling me that any amount that I'm going to be paying, any expenses that I'm going to be incurring, you reimburse me back. It means that if I have paid 10 million, you are going to be giving me 10 million. So I need to have a refund. I need to recognize a refund asset or a contingent asset for that one. Apart from that one, the best that we can do is to disclose. We don't recognize contingent what assets. But for contingent
Please,
liability,
the 35 million is at 31st December 2020, not 30th June 2022.
sorry. So it is assessed the probability of payment in relation to the contingent liability is more likely than not as at 31. Oh, no, look at this one. We are reporting on 2022. Reporting date is
Yes.
2022.
Yeah. But the date is 31st December 2020.
And that
Yeah,
2020 will be part of what? That 2020. This we are doing statement of financial position. Are you okay? So that 2020 over there will be part of the last few years, and that is not going to be changing again. Okay, so that will be part of the reporting again. The liability from 2022 will be the liability that will be there going forward. Are you okay?
Going to 2022. Okay.
Exactly. So that's why we are taking that one now.
Okay.
I hope we are clear with that one now.
Yes, please.
Okay. Let's come to the D.
D. During the year ended 30th June 2022, Mamponti made sales of 50 million cedis to Diamesi at 25% above cost. 60% of these goods were sold by Diamesi during the year. As at 30th June 2022, Mamponti has receivables with Diamesi of 25 million cedis.
Okay, so this is intra-group trading, isn't it?
Yes, please.
Okay. The subsidiary is selling goods at 50 to the parents. Okay. This one is intra-group trading. Okay. The sale that the parent is going to be making will be the sale for the subsidiary because I'm just giving the goods to you to sell on my behalf. Okay. I'm not selling to you. I cannot sell too much to a company that I own, but I'm asking the company to sell those goods for me. Okay. So, but since we are all going to be keeping separate financial statements, we are going to be having separate financial statements. We are going to be keeping separate records. I'm going to be recording this as a sale, and you're also going to be recording this as purchases. So me, I've recognized all the profit on this particular item. So now that I'm coming to add the two companies together, okay, the sale for the group now will be the sale made by the what? By the buyer. So it means that all the entries that has been passed by Mamponti must be reversed. Okay, you don't have to stress yourself. If you are doing statement of profit or loss, you take the total sales from revenue and you take the total sales from cost of sales. Why? The parent is having that one in their revenue as sale. The subsidiary is also having the same figure as what? As cost of sales or purchases. Then you remove that particular figure. Then you come to the issue of the unrealized profits. We have done this. Okay, if you want to get the detail of this particular one, okay, you can check our YouTube channel where we have intra-group trading, assurance professional school, intra-group trading, like 1 hour something video. We have taken our time to explain the logic behind the intra-group trading. We are not here to do those things now. So let me just show you what you are going to be doing when you go into the exam hall. If it is statement of profit or loss, remove the cells because there cannot be cell between the two groups. The parent is going to be having 50. The subsidiary is going to be having 50 as revenue. The parent is going to be having the 50 also as purchases. Go and remove that. Okay, but the parents removed the closing stock that the parent is supposed to remove. It's supposed to be a cost, but the parent removed the closing stock at what? At net realizable value, which is higher than the cost. So you bring that particular difference back, which is the provision for unrealized profits. But this one, we are doing statement of financial position. We just calculate the profit element that's here to be recognized, that has been recognized by the subsidiary. The time that the subsidiary is dispatching these goods, they have recognized the entire amount as a sale. So it means that they have recognized all the profit on this particular item. But all the goods has not been sold. So they have to recognize profit to the portion of the goods that has been sold. So what do we have to do now? The goods are 50 million. Now 60% of these goods were sold. It means that 40% were not what?
Sold.
Okay, so let's find the 40% of those goods and find a profit element on it. So let me come here and have provision for unrealized profit. Okay, So that will be 0.4 multiplied by 50 million. That is a portion of the what? The selling price of the goods that are yet to be sold. Okay. What would be the profit element on that? Let's come here. The goods were sold above cost, 25 above cost. The 25, is it a markup or margin?
Markup.
Markup.
Okay. But the 40% of the goods that are yet to be sold is a selling price. Is it a selling price or cost price?
Selling price.
Selling.
And we apply margin on what?
Selling price.
Selling price.
So we have to change the markup to what?
Margin.
Okay. So what will be the margin if you are changing?
To be
1/5.
3. Oh,
Uh-huh.
1/5, sorry.
Please, let me just say it again. I'll say it again. Margin should be lower than markup because margin is applied on selling price, where the selling price is higher than the cost. But we want to get the same answer at the end. We have to get the same profits. So if selling price is higher than the cost price, it means that the percentage that should be applied on the selling price should be lower. If cost price is lower than the selling price and we want to get the same result, it means that the percentage that should be applied on the cost price should be higher. So markup should always be higher than the margin. So if you are giving markup, it's either you add or subtract. So if you are giving markup of 25%, just ask yourself, if I add to the denominator and I multiply by 100, what am I getting? The answer that you are getting, if it is higher than markup again, it means that that is not a margin. So you have to subtract. Okay, so I can't sing that for you that if you are doing margin, add. If you are doing markup, what? Subtract. If you go there and you have forgotten and you now sing a wrong song, it's going to be having a problem on you. So this one, we just have to, markup is 25%. So margin will be what? Margin will be lower than that. So 25 over 100. If I subtract, if I multiply by 100, you'll be having more than that. 1/3 multiplied by 100 is more than 25%. Markup should be higher. So I have to add now. So that will now give you 1/5. Okay, what is the answer that we are getting?
$4 million.
4?
$4.
4 million.
Okay, 4 million. So who is selling? Who is having this particular profit in 8 books? Who is selling? The person selling is a Mapontin, isn't it?
Yeah.
Okay.
Yeah,
So
Mapontin is selling.
So it means I have to reduce, I have to bring this figure down now to be able to incorporate. Please, I hope we have these figures already so that if I take that one off, you can mention them to me. Okay. So I need to have this place for the, so I have provision for unrealized profits that has been included at what? In the profit as reporting. So I will now have my goodwill. So let me have my goodwill now here. So goodwill, that will be Argo 9. So we have purchase consideration, we have the share exchange straightforward. That was 1/3 multiplied by 390 multiplied by 6. That was 780. Then we have the contingent consideration of 143. Then we have the NCI of 340. And the total gave us 263. Okay, I'm sure. So what is the next entry? The Mapontin is carrying the goods at what? The Damasi will be carrying the goods at selling price, isn't it? Damasi will be carrying what? Those goods at selling price, which will be the selling price, the closing stock will be 20 million for what? In the books of Damasi. Is that correct? The closing stock relating to this one. 40% of the 50 million. That would be 20 million, isn't it?
Yes, sir.
Okay, that will be carried at what? At selling price. Okay, but the goods is still within the group. Inventory should be carried at lower of the cost, and then the what? The net realizable value. So the cost will be 16 million. So you go to your inventory, which is this figure over here, and take the 4 million. So you debit the net asset and credit the inventory with a provision for unrealized profits. Okay, let's come and see what we have to do over there. Are they saying anything about that? Okay, there's no deferred tax implication of this. If they ask you to show the deferred tax implication of this, how do you show it? The deferred tax implication of that particular transaction. Oh, we don't have any idea about the deferred tax issue relating to unrealized profits. We have done that. The time that we are doing income tax. Okay, let's come here. Okay. The tax figure that will be in the books of the subsidiary, which is the Mamponti, the tax figure that they are going to be having will be based on the total profit that they think they are making, isn't it?
Yes, sir.
Okay. Which the profit includes what? The sale on the inventory to what? Jamasi, isn't it?
Yeah. Yes, sir.
Okay. So it means that they are recognizing the total profit on this particular item. The time that the transaction has been sold, we have 0.2 multiplied by 50 million. And they are saying that they are going to be making a profit of 10 million on this transaction. So this profit has been included in their revenue, and they have estimated their tax based on this figure. So the tax expense is relating to the total profit on this particular one. Now you are removing 4 million from the profit. It means that the tax related to that particular 4 million should also be removed. So what we do over here is that the deferred tax implication will be 0.25 multiplied by the profit that we are removing. Okay, because the profit, the tax figure we have over there covers the profit over here, which is the 4 million, because we estimated our tax based on what? Based on the total profit that we are making. And now we are taking 4 million out of that one. It means that the tax relating to that should also be taken away. So what we do is you multiply this by this one, then you'll be having one. That particular 1 million will be taken away from the tax expense. But if you are doing statement of financial position, you go and add this to the net asset because the tax has been taken away from the profit. So you go and add it to the net asset by reversing the 1 million. Then you treat this as what? As a deferred tax asset. As a deferred tax asset. Why is it a deferred tax asset? Because this 1 million is included in our current tax. So you either go and subtract this from the current liability where the tax is there, or you treat it as what? As a deferred tax asset. Any of them is accepted. But they haven't examined this part already. They haven't examined this one before. So you just have to know that if they ask you for deferred tax implication, the seller estimated a tax based on the full transaction. So if they are now removing the profit, it means that the tax related to that profit should be removed as well. So you calculate it, the tax element on it, calculate it, go and add it back to your profit, and go and subtract it from your current tax. Because the 1 million is included, is part of the estimate, which is that particular one. This is done at the group level. This is done at the group level. And if we take the additional one on that particular one, then we move on.
On 1st January 2022, Mampontin sold the machine to Jamesi for 55 million cedis at a gain of 10 million cedis. The remaining useful life of the machine at the time of disposal was 5 years. Show the deferred tax implication of this transaction. The appropriate tax rate for tax adjustment is 25%.
Okay, so this is also transfer of PPE. Okay, if you have a branch, okay, if you have a branch somewhere and a branch has an asset and a branch is not using the asset, if you want to use that particular asset, would a branch sell the asset to you?
No.
No, it will be a
Okay.
transfer.
They'll just give you the asset to you to use, isn't it?
Yes, sir.
Yes,
Okay.
sir.
So should the Mampontin be selling the asset to the parent?
No.
Oh, sorry. Let's come to the receivable. Mampontin has a receivable with Jamaica of what? 25 million. Okay. If Mampontin is having a receivable, Jamaica will be having payables of 25 million, isn't it?
Yes.
Okay. So
Yes,
this
please.
is intra-group balance. So go and subtract it. Thank you for that. I didn't pay attention to that one. So we come here, our other
So
current,
which footnote is that?
so that will be 25 million, and our current liabilities will also be 25 million. So it means that they have intra-group balances. We cannot be owing one another. So I'll remove 25 million. You also remove the 25 million at the group level. Thank you for that. Okay. Let's come to this issue. Okay. Let's come to this issue. So on 1st January 2022, Mampontin sold the machine to Jamasi for 55 million at a gain of 10 million. Okay, the remaining useful life of the machine at the time of disposal was 5 years. We are saying that you cannot sell. Okay, you only give the asset to me to use, and I'll use the asset for the remaining useful life. So the portion of the asset that is yet to be used, you give it to me, then I'll use it for the remaining useful lives. But you are now saying that you are selling this to me, and I'm treating this as 55 million. Okay, in actual sense, at the group level, this should not be a sell. I'm using the assets on your behalf. So the asset should be transferred at what? At carrying value, not what? Not fair value. Okay. We assume that the asset is carried under cost model. The asset is carried under cost model. So you don't have to fair value before you transfer. Okay. So the asset should be transferred at what price? The asset should be transferred at what price? The asset should be transferred at what price?
45.
45 million. Okay. The asset should be transferred at 45 million. Okay.
Yeah.
Yes, please.
I think with the we haven't treated that is the footnote, that is the D, as at 30th June 2022. Mamponti has a receivable with Jamasi of 25 million.
We have done that now. I've separated the 25 from their other current assets and liabilities. So that is intra-group balances. So if Mampontin is having 25, Jamasi will also be having a payables of 25.
25.
Okay, all right. So this particular asset should be transferred at what? At 45 million. But the assets has been given to Jamasi at what? At 55 million. There is a gain of what?
10 million. That's
10 million.
Okay. So what do we do? What do we do? We have to reverse the gain, isn't it?
Yes, sir.
Okay. So they say we should show the deferred tax implication of this. So if you are reversing, reversal of the gain, because Mampontin is the one selling. So the gain has been included in their what? In their okay. I'll bring only the because I don't have space over here. I'll bring the net amount relating to the deferred tax over there. So I'll just bring the net amount. Okay. I'll just bring the net amount relating to that particular issue over there. They are saying that we should show deferred tax. In actual sense, nobody's going to ask you for that. Okay, let's come here. So we are going to remove it. So we now carry the asset at 45 million. We now carry the asset at 45 million. So what will happen is that we will now debit the return or the net asset, debit the net asset at reporting. Okay, because the profit, the gain has been included that particular figure, that is 10 million. Okay, then we now credit the asset because they are also carrying the asset at 55 million. So we remove the 10 million from the asset. So now go and do that for the assets now. So the 55 million is here. So we take the 10 million from this one. The net asset, because I don't have space over there, I will show the effects, including the deferred tax on this one. Okay. You can see that the tax, okay, the tax for the year which Mampontin is going to be paying is based on the 10 million, isn't it? The 10 million is also part. They have also estimated the tax on the what? On the gain that they are recognizing of 10 million. Since you are removing the 10 million now, it means that the deferred tax or the tax that is on the 10 million, the tax estimate that is on the 10 million should be taken away. Okay, it should be taken away. So you come here and have the deferred tax implication or the tax implication of this one. This will now be, okay, so we have 0.25 multiplied by the 10 million. What are we having as a difference?
That's 2.5.
That is 2.5. Okay. So it means that the gain, if we are reversing the gain, we have to reverse the gain together with the tax. So we are reversing the gain, the tax that we are charging of 2.5 should also be reversed. So in actual sense, we are going to be reversing only 7.5 of the gain. Okay. We are going to be reversing 7.5 of the gain. So we reverse 7.5 of the gain because we take the gain and we add the tax back because the tax on the gain has been taken away from our profit already. So we go and add, do that particular one. Okay, because I don't have space over there. So the reversal, of the gain, net of tax, reversal of the gain, net of tax. Please, this nobody can ask you, or this they might not ask you. This is the first time that you are seeing this. I just added it. Maybe something might happen and you ask, and you have to be able to do it. So that would be 10 minus the tax, which is 7.5. Okay. This 2.5 is included as tax in our what? In our current liabilities. You can treat it as a deferred tax asset, or you can subtract it from your what? From your tax, from your liabilities, which is the tax is there. So we take the 2.5 from here. Okay. Then let's now come to the implication of depreciation on this particular transaction. The implication of depreciation on this particular transaction. Okay. The Jamasi has charged what? What is the depreciation charged by Jamasi? What is the depreciation charged by Jamasi for the year? They charge the depreciation on the 55. Do you agree?
Yes.
Okay. So the depreciation that was charged by them was 55 divided by what? 5
5.
multiplied by 6 over 12. Do you agree?
Yes, sir.
The sale was on 1st January. Reporting
Yeah.
date is 30th June. So that will be 6 months. Okay. So how much are they getting there?
2.75.
Is it 2?
No, 5.5.
Okay. So that will give us 5.5. But what should be the depreciation that should have been charged? Depreciation should have been charged on the 45 million, isn't it?
Right.
Okay.
Yes, sir.
Yes, sir.
So actual depreciation should have been on the 45 million.
Mm-hmm.
Actual depreciation should have been on the 45 divided by 5 multiplied by 6 over 12. What are we having?
4.5.
Okay.
4.5.
So instead of charging a depreciation of 4.5, they have charged a depreciation of 5.5. So it means that we have to reverse how much?
1.
1 million.
Okay, so we have the 1 million as excess depreciation. So this 1 million, what we do is we debit our assets. Why do we debit our assets? Look at this one. In the financial statement of Jamasi, Jamasi is going to be having this as a carrying value. They are going to be having 55 minus 5.5. Is that the case? In the separate financial statement of Jamasi, they're having 55 minus the depreciation charge, isn't it?
No.
Yes.
Okay, this is the value that they have. Okay, but what did we do? Look at what we have done over here. We have taken 10 million from that figure, isn't it? We are now reversing the what? The 55 back to 45. Do you agree to that? Okay, so we have taken this one over here. So this is what we have done. We have 55 minus 5.5, and we have taken the 10. We are taking the 10 with a mindset that we are reducing this particular figure to what? To 55, to 45. If we are reducing this to 45, it means that the depreciation that should have been charged should be 4.5. So this is what we have done in their statement. 55 minus 5.5, and we have taken the 10. The 10 that we are taking, we are bringing back this particular one to 45. If we are bringing to 45, this should be what? 5.5, 4.5 rather, but we are taking 5.5. So we can add the 1 million back to net the effect over here to what? To 4.5. So this will be debit assets of 1 million, and credit what? The net asset at reporting, because the depreciation has been taken away from net asset at reporting. Net asset at reporting. So we have the 1 million there. You have the 1 million there. I will show you, but they say the deferred tax on this one. I will not bring it over here because I don't have space again. So I will just show the deferred tax implication on this particular transaction. So this will be 1 million now as a reversal. Okay. Let's say we should show deferred tax implication on this one. A very simple exercise over here. Okay. Okay. In the separate financial statement of Jamasi, they are having 49.5 as a carrying value. And this carrying value is the one that they use to determine what? Is the one that they use to determine the tax base of the asset. Okay, this is the one that they use to determine the tax base of the asset. Now, since we are removing this particular transaction, our carrying value will now be in the group financial statement will now be 40.5. Do we agree? Our carrying value, if we reverse this, it will be 45 minus 4.5. That will be 40.5, isn't it? Okay. Then we now have 9 million. It means that our temporary difference is now reducing by 9 million. So you multiply this by 0.5. So there's a reduction in the deferred tax. You will go and debit your net asset by adding it to your profit, and you reduce it from your current liabilities. But don't worry, nobody's going to stress you with this one. Okay. What do I want to say over here? Sometimes the question cannot give you the what? The carrying value and also the fair value. They can just tell you that the asset has been sold to the person at a gain of what? 10 million. So if the asset has been sold at a gain of 10 million, it means that the person has charged a depreciation of 45 over 5 multiplied by 6 over 12 plus 10 over 5 multiplied by 6 over 12. Can we agree that this was a depreciation charged by the parent, Jamasi? The 5.5?
Yeah.
Yes, sir.
Okay.
Yes.
So if we are reversing this, it means that we reverse the depreciation on this one also, isn't it?
Yeah.
So you just charge the depreciation that was charged on the gain. The gain has been added, so we depreciated the gain too. What was the depreciation charge on the gain? So this 1 million can be calculated as 10 over 5 multiplied by 6 over 12. That is the depreciation element relating to the gain. So they will not give you the carrying value, and they will not give you the value that they have sold the item. They can only give you the gain. So just remove the gain and charge the depreciation on the gain. And that will be the reversal of the depreciation. Okay, let's go with that one. We are actually what? Okay with this one now. So I can actually reverse this particular one, the one. Let me go and add the one to my assets over here. So add one here. Then we move on. Okay, this seems to be very long. Okay, let's see. Maybe this might be the last one. Then we move on. Auntie Vic.
Yes, please. E. Jamesi measures NCI in Agona at fair value, but measures NCI in Mampontin at proportionate share of net assets.
Okay, let's stop there. Let's go and do that particular one. So let's calculate the net asset of Mampontin at acquisition. What would be the net asset at acquisition? Mampontin at acquisition is what?
$1,132.5.
No, that is Agona. The first one is Agona. This is Mampontin. 400 plus 185.
Yeah, sorry.
I'm having 590.
590.
Okay, there's no other issue there. So let's come to fair value of NCI. We put all the NCI together. Okay, so fair value of the NCI. You can add a name. This will be Agona, and this will be Mampontin. Okay, that will be 30% of the what? The 590. So let's have 0 point, this one, 0.590. What are we having?
177.
One, okay, 177. Okay, so let's calculate the goodwill in Mamponting. So let's have the goodwill in Mamponting now. So the goodwill in Mamponting can easily be calculated. The consideration was 450. So the consideration was 450. We are using proportionate method. So we just look at the net asset that the parent is buying. That will be 0.7 multiplied by 590. What are we having?
413.
Okay. So what will be the goodwill? The parent is supposed to, the parent is paying 450 for 413. What is happening there? That is a goodwill of 37, isn't it?
Yes, sir.
Okay. Let's do the goodwill for these people, for Aguna. What is their net asset at acquisition? 650 plus 300 plus 120 plus 30 minus 7.5. I'm having 1092.5.
Yes, sir.
Okay. So let's go and calculate that now. So their net asset at acquisition will be 1092.5. What will be the goodwill?
170.5.
Okay. 170.5. Okay. So let's go to the last one and see whether there will be an impairment there.
F. The goodwill arising from acquisition of Agona was impairment tested. The recoverable value of Agona estimated at this date was 1,495 million. There has been no impairment in Mamponting's goodwill since acquisition.
Okay, so what they are just saying is that impairment, they can also give you this particular one. Impairment has been tested on the what? On the goodwill arising from acquisition of Agona on the 30th June, which is the reporting date. Okay. And they are saying that the recoverable amount of the net asset of Agona was 1495. So we just find the carrying value of the net assets of Agona at what the reporting date. So that's what we do. We just compare the carrying value with what? With the recoverable amount given to us. So let's come to the carrying value of their net assets at reporting. Agona 650, 510, 230, and those ones. What are we having? 650 plus 510 plus 200 plus 30 minus 3 minus 6.75. I'm having 130. 1380.
1380.25.
Okay. So that is the carrying value of their net assets. So you come here and have impairment testing. Okay. Impairment testing. So you have, that will be at 30th June 2022. So you look at their net assets. Okay, their net asset excluding goodwill is 180.25. Okay, what is the goodwill arising from the acquisition? What is the goodwill arising from acquisition? What is the goodwill arising from acquisition? 170.5, isn't it?
Yes.
Oh, this is supposed to be 13, not 18. Okay, 13. Okay, but the net asset that we have calculated over here is net asset without the goodwill. But the goodwill is relating to who? The goodwill is relating to what? To the Agoni. So the goodwill is part of their net asset. We are having the goodwill. The goodwill can be the workers they have, the location that they have. That is goodwill is what is relating to them. So you add the goodwill at what? At the reporting. So if there was any impairment on a goodwill first, you subtract it, but there was no impairment. So you come and add a goodwill over here, which will be 170.5. What should be the total figure?
1560.75.
Okay. 1560. Okay, so the net asset is 1380. Okay, 1380. So let me come here and have 1380.25. Okay, so we have the goodwill now will be 1550.75. But what is the recoverable amount of the asset given to us?
1495.
Okay, 1495. Okay, so is there any impairment here?
Yes, sir.
Is how much?
65.75.
55 point what?
7.
575.
Okay. Which of the asset is going to be taking it? Net assets and goodwill. Which of them is
Goodwill.
okay, goodwill will be the
Goodwill.
one. So you impair their goodwill by that figure. So their goodwill, you count the impairment on the goodwill for them. So impairment will be 55.75. So what will be the goodwill at reporting for them? That will be 114.75. So you put the two goodwill together. You put the two goodwill together. The one on Maponten and the one on the Agona. You put the two together and you have your total goodwill. Okay. Let me talk about this one before we pick another question. Okay. Please, if you find your net asset at reporting, check the net asset at reporting here. What is the post-acquisition profit here? For Agona, what is the post-acquisition profit? The difference between the two. One 1380.25 minus 1092.5. I'm getting 370.75. Can someone confirm that? The difference between their figures, okay?
My figure is different. 287.75.
287. A.
Yes, sir.
1380.25 minus 1092.5. Okay, 287.
Yeah.
Okay, 287. Please, this 287 is not entirely what? Profit for the year. Are you okay? Let's come here. You can see that we have included other components of equity in the calculation, isn't it? Okay.
Yes, sir.
Look at the movement in the other component of equity here.
80.
80. Are you okay? Okay. The 80 over here is the 80. The increase of 80 is part of the what? The reporting figure over here. So it means that if the 80 is not part of the reporting figure, the profit that should have been made for the year would have been 207.75. So after you have gotten the difference between these two figures, ask yourself, what is the portion that is relating to other components of equity? The parent will take each share of that changes in other components of equity to each other component of equity. However, the NCI is going to be taking the share of the two. So NCI, you can share this one to the NCI. But what will happen is that this particular figure, which is the difference in the net asset, the parent is going to be taking each share of the other component of equity to what? To other component of equity, and each share of the profit, the movement in the retained earnings, the parent will take it to retained earnings. But the NCI will be taking the two to NCI. So you have to be able to establish what portion of this one. Mostly it is always in corporate reporting where you have to establish which portion of this one is for other component of equity. How do we establish it? Look at the movement in the other component of equity. It was 120, it is now 200. So it means that the 80 is included in this one because there is no adjustment to the other component of equity. So out of this figure, 80 is inside there. If the 80 is not there, what should have been the difference? That is the actual post-acquisition profit. So the parent will take each share of the post-acquisition profit to retain earnings and the share of the movement in the other component of equity to each other component of equity. If you come to this place, you do the same thing. This will be 50. So the difference that you'll be getting at the end of the day, you take 50 out of it. The remaining will be the post-acquisition profit. That's how you have to do for, especially if you come to corporate reporting. They normally examine this side of it. So the post-acquisition profit, the difference is not entirely profit. Other components of equity is there. So get the portion, take the parent onto that other component of equity for the parent. But the NCI will be taking the share of profit to NCI, and they will be taking the share of other components of equity to NCI. So you can share the total to the NCI. You can share the total to the NCI. Okay, so basically this is what we are going to be doing. Let's see if we can pick a question on complex group structure, and we discuss that of step acquisition, mostly step acquisition and complex group structure. Okay, so let's see what we can do. That will be question number 2. Okay, question number 2. It's not that I've loaded a question. I've done it like this so that I can use one question to explain maybe most of the things that I might not have the time to explain. Who is the parent over here? Question number 2.
Abokobi.
Okay, so what do we have to do?
80%. Goodwill is the subsidiary.
Okay, so what we do is that we can actually what? We can start adding the figures now for the what? For the parent. So it's the same thing as statement of financial position. Okay, so let's have the statement of financial position here. Okay, let's have statement. But this one, we are going to be working this one together. So everybody has to participate. So let's come to the Abokobi group. Okay, statement of financial position as at that particular date. So we have their PP. I'm not sure they have 3 zeros at the top. So we have
Engineer Labra.
we have assets.
Hmm?
We have non-current assets. Okay, so we have their PP. What is the value of their PP? $596. 596. Okay, 596. 330. Okay, so the investment might be the respective investment. So you can bring it and you subtract it later. Okay, at the end of the day, you have to reconcile. There might be other investment over there. So you can just actually reconcile that one with the amount that they are going to be paying. So you can have your 50,000 there. Okay, for the parents, 500,000 rather. So you have 500,000 for the parents. Then you can leave space. Then you count your current assets because goodwill and other things might be coming there. So you have current assets. Their current assets, are we giving just a figure? Okay. If it is like that, sometimes it will favor you in terms of time, but it will also go against you in terms of ticks. Okay. So let's come to their current asset figure. How much is that figure?
87320.
87320. Okay. So we come to their equity and liabilities. Equity and liabilities. So equity and liabilities, we have the share capital of the parent. What is the share capital of the parents?
100,000.
Okay, 100,000. So we have the group retained earnings. We'll go and do workings for that. Group retained earnings. Then we have, do they have other components of equity?
Yeah, other reserves.
Okay, other reserves. Okay, other reserves. Okay, so we come to NCI. They just have one figure for non-current liability and current liability. Is that correct?
Yes, sir.
Okay, so you have your liabilities over here. Then you have non-current liability. Okay, non-current.
Afternoon. Sorry, I'm in class. You are cutting my phone.
The person who is calling, if the person should know what is happening at this moment, maybe that person will go and fetch
They don't know.
1 gallon of water and put it there. Okay, last time I was there teaching, and my junior brother was here saying a lot of that. You don't know what you're saying. Maybe if you read this teach and you know what we are talking about. It's not easy, but I would want. Okay, 150,000. Okay, how can you learn all these things within 3 months? Okay, current
Serious.
liability. Right. That's why they made it 50 marks. Okay. Okay. I know you will say that getting a 50 marks is an issue, but don't worry, we'll be very fine.
Amen.
43,250. Okay. So we can do the group structure now. We know the group structure, how to do the group structure. So that one, we are going to be ignoring that one for now. Okay. So I'll just put a group structure here because I won't repeat that one again. So we have the workings. You please go there, do your group structure in the table form, the way we have done that particular one. That one that they have been doing like this, please. If you're not familiar with it, just do your group structure in tabular form and move on. Okay, so we have the workings here. Okay, there will always be a subsidiary. So we have the group structure to be, okay. I'm saying that you can do the workings anyhow, but if you name it, that will help you. So that if you find this particular figure, you go and do the entries and come back. So we have the group structure to the first one. Let's leave a space. We come to net assets. There will be a subsidiary, or there will even be two subsidiaries. There's no problem with that. So we have acquisition and reporting for them. Acquisition and reporting. As soon as we have seen two subsidiaries, okay, should we do the net assets as one? Should we do the one that I'm saying that you can combine the two? Should we try that one too? If we are going to be trying that one,
Yes,
then
sir.
I have to take this one from here. Okay, so I'll go and do it on a normal page. So I'll do okay, let me extend this one small. Let me extend it to this place small. Okay, let me extend. Now, if I want to extend, I'll do it on a different page. So let me have this thing. So let me have goodwill calculation here. Okay, so we have goodwill calculation here. Okay, the goodwill calculation. The goodwill, if I calculate, okay, let me have my net asset over here now. So the net assets. So I'll have acquisition for one person. I'll have acquisition for one person, and I'll have reporting for the other person. Then I'll still have acquisition for one person, and I'll have reporting for the other person. Okay, so you put your currency sign here, you put it over here, you put the currency sign here. So you just put a name under each of them. So let me just put the net assets here at the middle so that it will make sense. So the person over here, we put the name over here and put the name also over here. Okay, and that will be cool. So we can actually go to our NCI. We can actually go to our NCI now. Then we come to our group retained earnings. For the group retained earnings, what is the parent figure? That one to be very simple. What is the parent figure for the retained earnings?
$875,400.
875,400. Okay. So let's go to our other reserves. So other reserves. So let's have other reserves. So the other reserves, that will be for the parent. What is the parent figure?
15,000.
15. Please, can you take it again?
15,000.
Okay, 15,000. Okay. So after doing this, we can take the footnotes now one by one. Auntie Vic, are you still with us?
Yes, please, I'm here.
Okay.
Additional information. A. Abokubi acquired 80% of the equity shares of Dodowa on 1st May 2018 at a cost of 350 million cedis. At this time, the retained earnings balance of Dodowa was 255 million, and the fair value of NCI was 80 million cedis.
Okay, so let's come here. So we can see that the parent has acquired 80% of another company. So the parent is having control. But let's check whether the parent has disposed of any of that particular one. This is actually a step acquisition. So I don't think there will be a disposal there, but we still have to check. Okay, we still have to check whether there is a disposal of this one. This is actually about complex group structure. Okay, so the one dispose 5%. Okay, there's no disposal there, so we can consolidate that of Dodo one now. We can consolidate this thing for Dodo one now. We can consolidate that now. Okay, so let's go there and consolidate. Okay, so 80% we are consolidating. Their PP, that will be 355,370. So we have, that will be 355,370. Their investment is 300,000, isn't it? Okay.
Yes, sir.
Their current asset is what?
56550.
56550. Okay. Their non-current liabilities,
80,000.
80,000. Their current liabilities is what?
31,420.
31,420. Okay. So we have to also go here now. So we can have issue about a group structure for them, isn't it? So we can have a group structure here. You go and put it over there. We can have issue about the NCI. The question has given us the NCI, isn't it? Fair value of NCI in Dodowa. Okay, what is the fair value given to us at acquisition date?
80 million.
Okay, 80 million will give us 80,000.
80,000, yeah.
Okay, can we do their net assets now at acquisition?
Yes.
Okay. So their share capital is how much? Are you looking for it in the footnote? Share capital is how much?
75,000.
We say that at reporting is the same as at acquisition because the parent is going to be maintaining the same percentage control throughout. So that will be 75,000. At acquisition, at reporting are the same. So 75,000. 75,000. Okay. Then retain earnings. What is their retain earnings at acquisition?
$255 million.
Okay. So 75,000. We have 255 million. So that's 255,000, isn't it?
Yes.
Yes.
Okay. Do you have other components of other reserves? Other reserves for them. They don't have any other reserves, even
You don't have.
Okay, they don't have other reserves. Okay. So maybe there can be other reserves during that one, but they don't have for now. So we keep that one now. Okay. Let's go to the B. We are done with the first one. Let's go to the B now.
B. At May 1st, 2018, it was determined that land in the books of Dodowa with a carrying value of 100 million cedis had a fair value of 135 million cedis.
So what is the entry that we are going to be passing for this one?
We will increase the land, the PP with the 100.
With the what?
And at a
135.
With
with
the
the 35, the
With the
35.
difference.
100 and one, some people are saying 135. And I WhatsApp you, how was the paper? And you'll be telling me that you have screwed the paper. So that we increase the PP and they'll also increase the net assets at acquisition, isn't it? Okay. So we come to the PP over here. That will be 35,000. But this land will still be at the reporting date, isn't it? Okay. So we come to land over here. That will be 35,000. This land will still be 35,000 at the reporting date. The land, we are not going to be depreciating it. Let's look at their retained earnings at reporting. What is their retained earnings at reporting? 525, 500. Okay. Retained earnings is 525, 500. So 525, 500. Okay. So we pause on that one now and be moving. There might be some deferred tax issues there. Okay, can we have how much was paid? How much are they paying for? They have paid 350 million, isn't it?
Yes, please.
Okay, so we can we can have that as purchase consideration. Okay, so the purchase consideration was 300 and what? 50,000, isn't it?
Yes.
Okay. It means that included in the 500,000, 350,000 is for what? Is for investment in what? In the subsidiary. So we come and take that 350,000 from here. Okay. Minus 350,000. So it means that this will be cancelled together with the equity. So that's why we are not bringing their equity. So 350 as purchase consideration and 350 included in the investment. Okay. Let's be moving small.
C.
Yeah.
The balance on other reserves relates to movement in the values of investment measured at fair value. 12 million cedis of this relates to the investment in Dodowa.
Who is having the other reserves?
The parent.
Okay. If you acquired what? If you obtain control over a subsidiary, do we carry the investment as a financial asset?
No.
If control is
No.
obtained, we account for the investment either in line with what? IFRS 3 or IFRS 10, isn't it? Okay.
Yes, sir.
But you can see that the parent is carrying this at what? At fair value. They are accounting for this as if it is what? It is a financial asset. And they are fair valuing it at the end of every year. And we can see that the investment in Dodowa has increased by 12 million. That particular amount should not be what? Should not be recognized as what? As a gain. So we go and reverse it. For the parent, we go and reverse that particular one. It means that they are carrying the investment in Dodowa as a financial asset, this will be through other comprehensive income.
Other comprehensive income.
If it should be through profit or loss, it will be in the retained earnings. This is a financial asset through equity instrument. So we have only two classifications: other comprehensive income or profit or loss. So since they are having this on other reserves, it means that they are carrying this particular investment through what? Through other comprehensive income. And if this particular increase happens, what is the entry that the parent will be passing? If the value increases, what are the entries? If you're having investment and the value increases, what will be the entries that you are passing? You will debit the investment and credit what? Your other reserves, isn't it?
Yeah.
Okay. Now, this should not be done. We want to reverse it. So it means that we're going to remove the 2 million, the 12 million from other reserves at the same time from the investment, isn't it? So included in the investment over here, they have added 12,000. So we go and reverse all these transactions. So we come here, the investment, we come and subtract 12,000 from it. Then we come to the other reserves over here. Then we look at the reversal of gain on investment in Dodowa. Okay. So whatever you are going to be putting in, that should be subtracted. We don't account for a subsidiary as investment in what? As a financial asset, but that's what they are doing. So we go and take that particular one off and move on. Okay. Let's come here.
And that Kamalga folk, Tinabia Kadamapic.
D. D. Dodowa acquired 70% of the equity shares of Oyarifa on 1st May 2019 at a cost of 435 million cedis. 100 million of this cost is payable on 1st May 2022. Dodowa has recorded only the cash consideration. Appropriate discount rate is estimated at 10%. At this time, the retained earnings balance of Oyarifa was 285 million, and the fair value of the NCI was 175 million cedis.
Okay. Okay, so let's be okay. What is this one? The subsidiary is now acquiring a different subsidiary, isn't it?
Yes, sir.
Okay.
Yes, please.
And the subsidiary is now having a control. The acquisition is giving them a control, isn't it?
Yes,
Yes,
please.
sir.
Okay. So this is what we are going to be doing now. This is what we are going to be doing now. Okay. So the Dodowa is a subsidiary of another company, which is the Abokobi, isn't it? Okay.
Yes.
So under normal circumstance, if Dodowa should prepare what statement or consolidate statement of financial position, Dodowa is going to be consolidating what? The Oyarifa, isn't it? Okay. So Dodowa will consolidate Oyarifa. So Dodowa will consolidate Oyarifa. So Dodowa will add the each statement and the Oyarifa statement also. But the Abokobi will consolidate the Dodowa also, isn't it? Abokobi will consolidate Dodowa. Is that the case?
Yes, please.
Yes.
Okay.
Yes.
So if Abokobi will consolidate Dodowa, it means that Abokobi has to consolidate Dodowa and eight other operations. So the parent will now consolidate what? The Adodowa together with the Oyarifa, because if Dodowa want to prepare statement, it will combine Oyarifa and Dodowa. And if the parent also want to what? Consolidate Dodowa, and the parent will consolidate Dodowa and eat anything that is relating to Dodowa. So the parent will consolidate the two. So as far as this particular subsidiary is having control over this one will consolidate this one, and the parent will consolidate this one. So the parent will consolidate the Dodowa group as what? As just one. So the parent will consolidate Dodowa together with the Oyarifa. You can say the parent is not having any direct interest in Oyarifa. You can say the parent is not buying any investment in Oyarifa. Okay. But what will happen is that any amount or any returns that Oyarifa, that Dodowa will be having from Oyarifa, parent will be having 80% of that return. So if the return in Oyarifa, if the Oyarifa is making a profit of 100, Dodowa will have 70% of that. Okay. If 70% of that will give us 70. The parent will now have 80% of this. So it means that whatever Dodowa is having over here, the parent is having 80% of that. So mostly we find the parent indirect interest in the what? In the subsidiary. But the consolidation of the subsidiary does not depend on the parent indirect interest. It does not depend on the parent indirect interest. So you can do the parent indirect interest and that will give you 46. It doesn't mean that the parent is not having control. No. The parent is not consolidating the Oyarifa because the parent is controlling the Oyarifa. No. The parent is the owner of Dodowa, and Dodowa now is the owner of Oyarifa. So Dodowa has to consolidate Oyarifa, and the parent has to consolidate Dodowa. So the parent will consolidate Dodowa with its main work, with its operations. That's why the parent is consolidating the book. It doesn't mean that the parent is supposed to have control over them. But sometimes the parent can have direct interest. But what you do over here is that, okay, if I'm having 14% and you're having 46% in a particular company, and I'm the owner, I own you. It means that if in the time of voting, whatever I say, you are going to be complying to it. So if you put our two interests together, we are going to be having control. But if the parent is not having any direct interest, as far as the main subsidiary is having control, the parent will consolidate the sub-subsidiary, because the parent is consolidating the sub-subsidiary, because the subsidiary will consolidate the sub-subsidiary and the parent will consolidate the subsidiary again. So the parent will put the two together. So in most cases, what we do is we find the parent indirect interest. What do we mean by indirect interest? We are just want to make it very simple that any profit that is coming from the sub-subsidiary, what will be the parent percentage? It's very simple. We are saying that if Oyarifa is making a profit of 10,000 or Oyarifa is making a profit of 1,000, okay, the Ododuwa will be having 70% of that, okay, and that will give us 70% will give us 700. This 700 will be shared among the owners of Dodowa, which the parent is having 80%, NCA is having 20%. So this particular 700 right now, the parent will be having 80% of that. Okay, so we can say that the parent is having 0.8 multiplied by 0.7 of the retained earnings of Of the Oyarifa, because this will give you the Dodowa's own, and the parent will have 80% of that. So basically, we just find the parents which we call the indirect interest. The indirect interest is if you want to share the profit in the sub-subsidiary. What is the parent portion? That is the indirect interest. The indirect interest doesn't mean the parent is controlling or the parent is not controlling. No, that does not show control. Okay, as far as the main subsidiary is having control over the other company, the parent will consolidate that one, because the parent is now doing the consolidation on behalf of the main subsidiary. Okay, but we are just looking for the parent share of the retained earnings in that particular subsidiary. Okay, so these people are now having control over them. That is 70%. Okay, that is 70%. We'll be reading and now adjust this one. Okay, there is an issue somewhere which is going to be telling us something about this figure. Okay, but we have identified that the Dodowa is having control over the Oyarifa. So what do? We add the Oyarifa figures to that of the parent and then the Dodowa. So let's go and consolidate their figures now. Okay, so we have their PPE. Okay, what is the value of their PPE? Their PPE, Oyarifa PPE is what?
489,800.
489,800. So 489,800. Okay, they don't have any investment, isn't it?
No.
Okay, we will come and cancel this 35,000 here. We come and cancel it, but we are going to be doing that later. Okay, they have current assets. What is their current assets?
54,800.
54,800. What is their non-current liability?
30,000.
30,000. Their current liability is what?
28,850.
28,850. Okay, so we can come to this goodwill calculation will now be for Dodowa. So we can come to goodwill calculation for Oyarifa. So goodwill, we have the Oyarifa. So what is the purchase consideration? We are going to be looking at that one by one. They have cash consideration. They have cash consideration. And they also have deferred consideration. I hope you can see that. Okay. They are saying that Dodowa acquired 70 million of the equity shares of Oyarifa on 1st May 2019 at a cost of 435 million. 100 million of this cost is payable on 1st May 2022. Dodowa has recorded only the cash consideration. So it means that the total amount that is supposed to pay, they are saying that is 435, isn't it?
Yes, sir.
Yes, please.
100 out of it will be paid in what? In a year time.
Yes.
Okay. So if 100 out of it will be paid in a year time, how much are they paying in cash?
335.
335. So we go and write that as 335. The reason why that particular figure over there, if they recorded only the cash consideration, which will be 335,000, it means that the investment in Oyarifa should be what? Should be 335,000 as a positive figure there. But that is 300,000. The reason is this one. We'll go there and you see the reason. Okay. So H over here, on 1st January 2021, Dodowa disposed 5% of the equity shares of Oyarifa to the non-controlling interest for 35 million. Oyarifa's identifiable net asset as a proportionate adjusted for consolidation purposes on this date was estimated at 460. Dodowa has credited the proceeds of disposal to the investment account. So how much is this? 35 million. Okay. So that is a money coming in. That is money coming in. So if they have credited that, this is an asset. So this is supposed to be 335. So they have subtracted the proceeds from disposal from this one. So they debit cash and they credit what? The investment now. That is why this is not 335. It is the disposal proceeds that has been credited over here. That is the difference. So we will go there. If we reach there, we will account for that particular one. So what we do over here is that since they have credited that particular one to this one, we also come here and take the 300,000, because we should have added 35,000 and take all the 335,000. So we only take the remaining of the investment, which is 300,000. Okay, let's come to this one again. Deferred consideration. Yeah, Auntie Pearl.
Okay, Linus.
Yes, please.
Please, so let's say, in a case where the parent company does not have, let's say, indirect control of the subsidiary, are we going to add it to the financial statements?
If the parent is not having any control, if the parent is not having any direct investment in the subsidiary, okay, the parent consolidating this one depends on the investment that the subsidiary is having in the subsidiary. If the subsidiary is having only 40% of that, it means that the subsidiary will not consolidate the subsidiary, which is the Oyarifa. So the parent will be adding only the figures of what? Of the subsidiary. But Dodowa is going to be consolidating what? The Oyarifa. And the parent will be consolidating what? Okay, let me take it like this. Assuming no, yeah, you are my mother, so I cannot use this one as an example. Okay, assuming you have a daughter, you have a daughter. Okay, you have a, let's say she's above 20 years. Okay, and she has a child. Okay, she has a child already. If I'm coming to marry her, you cannot say I'll marry only her without a child. So I'll be taking her together with the child. That is a complex group structure. Okay, so I'll be taking her together with what? I'll be taking her together with the child. So I'll be consolidating the two of them. I will keep them in my house. Okay, why am I carrying the child? Because I have interested in the mother. And the mother will be carrying that particular one along. So everything that I have to do it for the two. The same thing applies to this one. The Ododowa is going to be carrying what? The Ododowa is going to be carrying the Oyarifa along. So anyone who wants to carry what Dodowa will carry Dodowa together with the Oyarifa. So Dodowa is having control over the Oyarifa. Dodowa will add the operations of Oyarifa to its own. So if the parent wants to consolidate Dodowa now, the parent will consolidate Dodowa and its other operations. Whatever Dodowa have interest in, the parent will have interest in that one too. So the parent will consolidate those ones. So we are consolidating because Dodowa is having control over the Oyarifa. But if Dodowa should be having less than 50%, the parents cannot consolidate because Dodowa in itself will not consolidate those people. So it will just be treated as investment and associate. Okay. But a situation where the parent itself is having a direct interest. Okay, let's say that the parent is having 20% in the Oyarifa itself. What you do over here is you come here. If the parent is having 20% and the Dodowa itself is having 40%. Okay, you consider the parents combined with what? The parents combined with the Dodowa, they are having 60%. If we count to voting, whatever the parent will be saying with the 20%, Dodowa will be saying the same thing because Dodowa is owned by the parent. So you put the two together and now consolidate, because if you put their two percentages together, that will give you 60%. Okay, so we only do a consolidation when there is an indication of control. If there's no control, you don't add. Auntie Pearl, I hope you're okay now.
Yes, please. Thank you.
Okay. So let's come to the deferred consideration. The 100 million will be paid in.
Linus,
Yes, please.
the cash consideration, are we recording or we are only to record the parent portion of it?
Oh, sorry. Assembly. Oh, thank you. So we are doing the goodwill, isn't it? Sorry. Let me have this one. Okay. This is for 70%. Okay, this 70%, it is being given by the owners of what? Of this particular entity. So whatever they are paying 335,000. Okay. They are paying 335,000, and that 335,000 is for 70%. Okay. So this 70%, they are paying it on behalf of the parent and then the NCI. So they are paying 335,000 for whatever return that they are going to be having. So what we do over here is that any amount, any interest that is in the what? In the subsidiary, the parent will be having 70% of this one. So the consideration will be shared among the parent and then the what? The NCI. So we have 0.8 multiplied by 335,000. Okay. How much are we having for the parents?
$268,000.
Okay. 268,000. Okay. So let's come to the deferred consideration. We are paying the 100 million in what? We are paying the 100 million in a year time, isn't it?
Yeah.
Okay. So if we are paying the 100 million in a year time, assuming we have cash now, are we going to be paying the same amount as the 100 million?
No.
Okay,
No.
so we do 100 over, we just find the present value, 1.1 multiplied by the parent share. What are we having? Okay, let's look at the cost of capital again. Okay, Dodua has only recorded the cash consideration. That is a 335.
Linus,
Yes, please.
the payment, I think it's more than in a year time because the purchase was done in 2019 and it will be payable in 2022.
So 1920 is 1 year.
So that's
2020,
3 years off.
and that will be 3 years.
Yeah.
Okay,
10 years.
1920 is 1 year. 2021. Okay, that is 3 years. Okay, so sorry, lights out bad there. Yeah. So I have 1.1 exponent 3. What are we having?
$60,105.18.
If we do it as okay, so parent share of the consideration is supposed to be 70% from where? The parents share, the parents acquire 80% of Dodowa. So whatever Dodowa is doing, the parents will have 80%. So the consideration that they are paying, the parents will pay 80% of that, NCI will pay 20% of that. So they are paying all those figures for the 70%. So whatever 70%, the parents will be having 80% out of it. And the NCI will be having 20% of it. Okay. So please find the deferred consideration for me. If that is not giving one figure, then do it like this: 1 over 1.1 exponent 3. Then you find this one to 3 decimal places. Then you multiply by the 100.
I had 6105.
We give you 75, 100.
Oh, what is the discount factor itself? 1 over 1.1 exponent 3.
The discount factor is 0.7513.
0.75.
13.
0.7751, 3 decimal places. Okay. So let's do 0. So let me just do this figure over here, which will be 0.751 multiplied by, that will be 100,000, isn't it?
Yes.
Multiplied by 0.8. What are we having?
Is the 6105?
Okay, 60.
105.
Okay. I'm getting 60080.
Yes, 60. Yes.
Okay.
60080.
So maybe they are doing it together like that. If you are getting decimal, just do it to 3 decimal places. So we have 60080. So this one NCI will have each share. So go to NCI. So this will be a reduction to the NCI. The NCI have to pay that portion. So we have the share of consideration in those people. So that will be just total this one. The total will be 335,000 plus 75,100. That's the total consideration. Okay, NC will have 20% of that. 335,000 plus 75,100. That will give us 410,100. So 0.2 multiplied by 410,100. How much are we having?
82020.
Okay, so we have 82020. Okay, so let's come here. That will be a finance cost. Okay, so we are going to be having finance cost for. So let's come to Oyarifa here. Okay, so Oyarifa, we'll be taking those figures one by one, small. So let's come to Oyarifa. So the parents are supposed to pay 100 million, but this will be paid in 3 years' time. So you are holding someone's money for 3 years. You have to be paying interest every year. So we have to identify the date that we are doing this. What date are we doing this particular one? We are reporting on 30th April 2021. Is that correct?
Yes.
Okay. So it means that the parent will charge interest for how many years?
2 years.
2 years. So let's do that particular interest for 2 years. Okay. So let's tackle that particular one. The interest, the finance cost will be calculated like this. So we have finance cost. You can calculate the finance cost like this. Okay. The finance cost will be 1.1 exponent 2 multiplied by the 7,500 minus 7,500. Okay. Okay, let me just do it one by one. Okay. So we do the finance cost for the first year. The finance cost for the first year will give us 0.1 multiplied by 700. Okay, what are we having? That will give us
7510.
Okay, 7510. Okay, then we come to the second year. The finance cost will be on 0.1, then addition of the two. Okay, 7,500 plus 7,510. What are we having?
82610.
82.
15,020.
Hey,
We give you 8261. And when we add that, we have 50,007.
Yeah, maybe 8,261.
so the 2 is the one that is giving us the answer.
Yes.
Okay.
So for this one is 8261.
Okay, 8261. So the total finance cost will now give us
15771.
okay, so we have 17771.
771.
Okay, who is going to be paying this? Is the Dodowa, isn't it?
Yes.
So we come to Dodowa, this figure, we have the finance cost over here. They are going to be paying that particular finance cost. So that will be reducing their profits. So Dodowa is going to be the one that will be paying the finance cost. So Dodowa will be treating this as what? As an expense, 15771. Okay. So what we do over here is what will be the total liability at the end of the second year? What will be the total amount that they are going to be owing now? That will be 75,100 plus the finance cost that has been charged up to date. What are we having?
That would be 98,71.
Okay, 9871. This will be paid within a year. It will be paid in the following year, isn't it?
Yeah.
Okay, so what we do is that this has not been recorded, so we treat it as now as current liability. That will be 9871, or someone can add it to the non-current liability and bring it back to this one. There's no problem with that particular one. Okay, so that is the issue of the deferred consideration. But let's consolidate. We have already consolidated the Oyarifa, but we have to do the net asset for Oyarifa. What is their share capital? What is the share capital for Oyarifa?
50,000.
50,000. So this is the double that I'm talking about. So you put a 50,000 here. You put a 50,000 here. Their retained earnings at acquisition is what?
Let me give you at reporting first. The reporting is 435,750.
435.
750.
435,750. At acquisition is what?
It's
8,285,000.
285,000.
82.
No, it's
28.
285,000.
Okay,
28.
5,000. Okay, let's go and see whether they have any fair value adjustment. They don't have any other reserves there. Okay,
No.
they don't have any other reserves. The NCA is what?
NCA 175,000.
Do you know the value of the NCA that they are giving? The NCA is not 30% too. The NCA value that they are giving to you is not 30%.
Yes.
Sometimes the question can give you 30% and they will give you what? They will give you the what? They will give you another figure. The NCA in Oyarifa is this. Okay. The main NCA is 30%, isn't it?
Yes.
Okay. But the NCA in Dodowa, which is 20%, will be having 70% of whatever is coming from what? From Oyarifa, isn't it?
Yes, please.
Okay. So what will give us, what will be the figure here? So the 20% of this, 20% of 70%, that will give us 14%, isn't it?
Yes, sir.
So NCI that is in Dodowa will be having 14% of what? Of any return in what? In Oyarifa. So we put those two. This is relating to NCI. So we put the two together and now say that the NCI in the subsidiary is 44. Why 44? 30 is the main one, plus the NCS share in the what? In the Oyarifa, which is 20% of the 70% that Oduwa is having there. And if you put the two together, you have the 44. Okay. That is so the question can give you the value of the NCI, which is 30%. They also give you the value of the NCI, which is 44. Please pick the 44 because we add the NCI in the Oyarifa ISA, which is 30%, plus the NCI influence in the what? In the Oyarifa. That will give us 44 what? Percent. So the 175 over there is 44. So we come to the NCI here. So we have the fair value of the NCI in the Oyarifa should be 195,000. Okay, so let's be moving to see whether there is any issue there for them. Okay, let's come to this particular one at E, the E.
E.
No.
At 1st May 2019, it was determined that the plant in the books of Oyarifa had a fair value of 20 million cedis below its carrying value. The plant is being depreciated over its remaining life of 10 years.
Okay, so at the date of acquisition, what is happening there? There is what? There is a fair value adjustment, isn't it?
Yes, please.
Okay, so they are saying that at 31 May 2019, it was deemed that the plant in the books of Oyarifa had a fair value of 20 million below its what? Carrying value. The plant is being depreciated over its remaining life of 10 years. This one is here downwards or upwards valuation?
This is a downward.
Okay.
Downwards.
So this would be a downwards what? Evaluation. So what we do over here is that we go to the Oyarifa statement, then this is supposed to be, so we can just name it PP, isn't it? So that we cannot bring the line here. So we just have PP over here. Okay, so the PP we are subtracting 20,000, isn't it? And we are also subtracting 20,000. Okay, I hope that is okay. Then we now come to the what? The post-acquisition implication of this. Let's go to their PP also and take the 20,000. Okay. If we are bringing this if we are removing this at acquisition, it means that the depreciation should have been charged on the new figure. Okay, depreciation would have been charged on the new figure. But what is happening is that the fair value adjustment has not been incorporated. So the question is this one. If the carrying value was 100 million, the fair value at acquisition should have been 80 million. This is just an assumption. Is that correct? If the carrying value was 100 million, the fair value at acquisition should have been what? Should have been 80 million. But this fair value has not been incorporated. It means that they have charged depreciation on this asset for how many years?
2 years.
2 years. So the depreciation that was charged by them was 100 divided by 5 multiplied by 2, divided by 10 rather. So that will be 100 divided by 10. And that will give us 20 million, isn't it? Is that correct?
Yes, sir.
Okay. But the actual depreciation should have been on what figure? If the fair value adjustment has been done, it should have been on what figure?
On the 80 million.
So the depreciation should have been 80 divided by 10 multiplied by 2. And that would have given us 60 million, isn't it? Okay. So instead of charging depreciation of 60 million, they have charged depreciation of what? 20 million.
20 million.
We have overcharged the depreciation by how much?
4 million.
So we go and what? Reverse that. That has been taken away from the profit. So we go and reverse that. Okay. But the question is not giving you this figure. The question is giving you only the what? Only the downwards revaluation. What it means is that the depreciation that they are charging every year was 80 million divided by 2 plus 20 million divided by 10, divided by 10, all of these answer multiplied by 2. So the depreciation should have been charged on 80. So what is the excess depreciation charge as a result of what? As a result of the downwards. So we calculate that one, 2 years depreciation, and go and add it back to that particular one because it has been, the total depreciation has been taken away from the profit. But the depreciation should have been charged on a figure which will be what? Less than the what? Less than the actual value by 20 million. So they were charging, the fair value has not been incorporated. So they were charging the depreciation on the original value. In actual sense, that original value has reduced by 20 million at acquisition date. So depreciation would have been charged on a reduced value, but we haven't done that. So what was the depreciation charge on the 20 million? So we come to what we call excess depreciation over here, which will be on the what? On this particular value. So we have excess depreciation. That will be 20 divided by 10 multiplied by 2, which is the same as the 4 million that we have calculated first. So we come to Oyarifa over here. The finance cost will be dash dash. We have excess depreciation over here. Okay, so we put excess depreciation over here. There is no excess depreciation in Dodo, so dash dash. This will not be at acquisition, to be at reporting. So we add our 4,000 back. Okay, we add our 4,000 back. Let's now move on to that 4,000 will be added back to the asset also. So we having 4,000 here as the, so the entry will be debit the asset and what? Credit your net asset at reporting, because that has been taken away from the profit. So we have to go and what? Add it back. Okay, we can actually show why we are adding the 4,000 back. Okay, we are removing the excess over here. If we are removing the excess over here, it means that the depreciation should have been charged on the 80 million, but they have charged the depreciation on the, okay. Okay, so let's come there again. Someone said his network is bad, and let's come here. So, senior, let me check the name. Okay, Auntie Vicentia, I hope you understood the 20 million reversal. Are you okay with the 20 million?
Yes, please.
Okay, so it means that the asset should have been carried at a value, which will be what? At acquisition date, the asset should have, if the carrying value of the asset was 100 million, this is what we are saying. If the carrying value of the asset was 100 million, and they are saying that the fair value was below the carrying value by 20 million, it means that at acquisition date, the fair value would have been 80 million. Is that correct? Auntie Vicentia, are we together?
Yes.
Okay, that would have been 80 million based on what we are having over here, isn't it?
Yeah.
Can we establish understanding for that and move on?
Yeah.
Please, can you hear me?
Can you come again?
Okay.
Please come again.
I'm saying that, so senior, it means that you're also in the same thing with Auntie Vicentia, but okay, you are a man, so you don't want to draw us back. You are a man. You have to be both. Okay, that is nice. So we are saying that the question is saying that the fair value at acquisition date was 20 million below the carrying value, isn't it? Okay, and I'm saying that if the carrying value of the asset at acquisition was 100 million, it means that the fair value at acquisition would have been 80 million, so that the difference would be 20 million, isn't it?
Yeah.
Okay. So this particular 20 million was not incorporated in the books of the entity. So they were charging depreciation on the original value of 100 million. So they are charging the depreciation on the original value of 100 million. And they have charged a depreciation of 100 divided by the useful life, which is 10, multiplied by 2. They have charged depreciation of 20 million, which was
20.
taken to profit or loss. Okay. But the actual depreciation should have been on 80. That would have been 80 divided by 10 multiplied by 2. That would have been 16, isn't it?
Yeah,
Okay.
difference.
So you can see that they have overcharged the depreciation by 4 million, isn't it? So we go and reverse that 4 million. So we add the 4 million back to this particular what the retained earnings. But since the asset is now going to be reducing, we reduce our net asset and reduce the value of the asset too, because they are still carrying the asset at the original carrying value. So you go and take the 20 million from asset, take it from the net asset also. Then you have to come and look at the implication of this fair value adjustment. What is the implication on depreciation? The subsidiary was charging the depreciation on the original carrying value, but they should have charged the depreciation on the value which will be 20 million less than the carrying value. So we just ask ourselves, what is the excess depreciation charge on the 20 million? That will be 20 over the useful life multiplied by the number of years that the asset has been used. And we have 4 million. Okay, so this 4 million, we credit our retained earnings of the subsidiary, which will be at reporting, and we now debit the value of the asset. Why are we debiting the value of the asset? Okay. Why are we debiting the value of the asset? We are debiting the value of the asset because of this. Okay, let's come here. In the statement, in the financial statement of Oyarifa, they are here to incorporate the fair value adjustment. So this is what they are having. They are having the carrying value relating to this asset as let's say it's 100 million. That will be 100 million minus 20 million depreciation, which is at 2 years. So minus 20 million depreciation. This is the carrying value that they are having because they are still carrying the asset at the original amount. They are here to incorporate the fair value. Okay, they are here to incorporate the fair value. Okay, now we are we are now establishing the fact that the value of the asset should have been 80 million. The value of the asset should have been 80 million. So if the value of the asset should have been 80 million, we will now come there and reduce the fair value adjustments. So we are reducing the fair value adjustment. It means that we are now bringing the asset back to 80 million, but we are still subtracting the depreciation of what? 20 million, because they have 100 minus 20. But we are now bringing the 100 to 80. The depreciation will still be there as 20. So if you are bringing the asset to 80 now, depreciation should be only 16. So it means that we have overcharged the depreciation by 4. So we should have depreciation of only 16 here taken from the 80, but we have 20. So we come and add the 4. So now make it 80 minus what? Minus 16. Then we have our carrying value. That's why we are adding the depreciation back. So we were adding the depreciation to reduce the effect because we are taking all of this one. So we are reducing this one to the original fair value. But the depreciation that has been charged over the years is still there, 20. So we have to bring it to the original depreciation. That is why we are adding. I hope the understanding is now clear and we can move on with that. But mostly they will not give you these values. So you just ask yourself, the depreciation, the 20 million should be taken away from the original value, but it has been included. So what is the depreciation charge on the 20 million over the 2 years? We do that and we take it as the excess depreciation. Then we go to profit or loss or the retained earnings at reporting for the subsidiary, and we add that one back. So that is the addition that we have done over there. I hope that is cool now. Okay, Auntie Vic, take that one for us. Then we now have the issue of, we have some issue of deferred tax there.
Yeah.
Okay.
F. The group deems any fair value adjustment as temporary difference. The appropriate tax rate for tax adjustment is 25%.
Okay, so what we are going to be doing is that we look at all the fair value adjustments and calculate the fair tax on them. That's what we are going to be doing. Is there any fair value adjustment relating to Dodowa? Is there any fair value adjustment relating to Dodowa?
Yes, please.
So there was excess amount of 35 million, isn't it?
Yes.
That is relating to land. So the fair value at acquisition will be the same as reporting, 35, isn't it?
Yes.
So that will be giving us the fair tax liability because the value of the asset is increasing. So I'll have the fair tax over here as liability. I'll use only one figure. So I have deferred tax liability or asset, depending on what we are going to be having. So we have deferred tax liability. So this one will be what? 0.25 multiplied by 35,000. What are we having?
8750.
Okay, so that will be a liability, 8750. Okay, 8750. The same figure will be there at what? Reporting, isn't it? Because we are not depreciating the what? The land. So the carrying value, the temporary difference at acquisition will still be the same as at reporting because the land is not depreciated. So we still have the 8750 here. Okay. But let's come to this place. Okay. Let's come to this place. Let's come to the one relating to Oyarifa. Assuming the carrying value was 100 million. Okay. The tax base was also 100 million. Now we are bringing the asset to a fair value of 80 million at acquisition date. You see that the tax base will now be 100 million again. Then we are going to be having temporary difference of 20 million. Do you agree?
Yes.
Okay. And this will give us a deferred tax asset because the value of the asset is reducing. So the tax base will be higher than the what? The carrying value of the asset. That will be a deferred tax asset. So at acquisition, we are going to be having a deferred tax like how we have it on the fair value adjustment. This is a reduction. So this will now be a loss to us. So the tax authority is supposed to give us a tax benefit on the loss. So we have 0.25 multiplied by 20 million at acquisition. That will be a deferred tax. What are we having? Assets.
5. Give
That will,
5.
that will give us 5, isn't it? Okay. So let's go. We have deferred tax liability. That will be under non-current. That will be 8750. Okay. Then we have deferred tax asset over here. If you like, you can net the two. Okay. You can net the two, but this is relating to Oyarifa, so you can present them different. One is for Dodowa and one is for Oyarifa. So the deferred tax assets at acquisition will be 0.25 multiplied by 20. Okay. Then we are going to be having 5. That is at acquisition. At reporting, would that value be the same as 20 million?
No.
The 20 million is
Yes.
for what? Is for 10 years, isn't it?
Yeah.
Okay, we have used 2 years already. So at what? At reporting, what will happen? At reporting,
It's reduced.
Depreciation. Yes. 60.
okay. At reporting, we have used 2 years of that particular figure. So at reporting, we are going to be having the deferred tax. Okay, deferred tax will now be on 0.25 multiplied by 20 minus 4. Do we agree?
Yes, please.
Okay, because 20, we have used 2 years out of it. The loss will be spread over 10 years. And we have done 2 years already. It means that we have reversed the loss. You can see that the loss, we have reversed depreciation of 4 years already. Depreciation of 2 years, which is the 4,000. So we have already enjoyed 4,000 out of that one, which is the same as 4 million. So this will now be 0.25 multiplied by 16. What are we having?
4.
That will give us 4, isn't it?
Yeah.
Okay. So our deferred tax asset at reporting will now be deferred tax asset at acquisition will be 5,000 and at reporting will be what? 4,000. So we go here and now subtract 1 million from this. Then we have a deferred tax asset of what? Of 4 million. A very simple one, but somehow complicated. Okay. Anything we are moving small. Okay. Let's come to the gene.
Linus,
Yes, please.
please, the net assets of the two subsidiaries.
Okay, sorry. One of
In
them should
terms
be
of
addition.
assets, yes.
Okay, thank you. Means that you're active. Okay. This is supposed to be 5,000 because it's a deferred tax asset. Okay, thank you. Okay, so let's be moving. Okay, let's be moving. So those who are doing giji that they want to join, now they can join. Okay, so let's come to the gene now.
Jane, footnote Jane. During the year ended 30th April 2021, Abokobi sold goods worth 35 million to Dodowa at a margin of 20%. Dudua still held 1/5 of those goods in inventory at the reporting date. Show the deferred tax implication of this transaction. Hello?
Yeah, I'm with you.
Okay, please, I'm done.
Okay, so who is selling here?
The parent,
So the parent is selling to who?
subsidiary, Dudua,
Okay, so what is the total value of the goods sold?
35 million.
At what? The goods were sold worth what? 35 million. So 35, is it a selling price or a cost price?
Selling price.
That is the selling price to the parent, isn't it?
Yes.
And they are giving you a margin too, so you don't have to do anything. So
No.
the saying that what is the portion of the goods that are yet to be sold?
1/5.
Okay, that will be 1/5. So what we do over here is that we just go and calculate provision for unrealized profit on this one. Okay, let's just bring the provision for unrealized profit over here because the parent is the one selling, isn't it? So the profit is included in this particular figure. So that will be 1.2 multiplied by 1/5 multiplied by 35,000. Do you agree?
Yes,
Okay. What do you have?
1,400.
1,000.
100.
Okay. So that 1,400 will be a reduction. Okay. The next, we debit the retained earnings of the parent and what? We take that figure from the inventory. Okay, so we credit the inventory of 1,400. They are asking us to show the deferred tax implication of this, isn't it? Okay. What is the deferred tax implication of this one?
They be an asset.
Okay, or we can actually go and reduce their tax one. So reduction, we can have a reduction in tax expense because the tax that we have estimated was based on total profit. So if we are now reversing 1,400 of the profit, it means that the tax element relating to that should also be reversed. So we have 0.25 multiplied by 1,400. What are we having?
350.
That will be 350. So that will be an
Yeah.
addition to us, isn't it? Okay. So the tax will be reducing by 350. What you do over here is that the current tax will be included in the current liabilities. So you can come here and subtract the 350, or you can treat it as an asset, or you can say tax refund or whatever, but you can net it against your current tax because the 350 has been included in our current tax estimate. So we take it away from this one. A very simple one. But I'm saying that they have not said anything about that particular issue before. They can also say it if you are doing theory. They can ask you the theory question under consolidation. They can ask you that particular issue on this particular one. So that is basically about that particular one also. Let's come to the H now and see what we can do.
H.
Yeah.
On 1st January 2021, Dudua disposed 5% of equity shares of Oyarifa to the non-controlling interest for 35 million. Oyarifa's identifiable net assets as appropriately adjusted for consolidation purposes on those dates was estimated at 460 million. Dudua has credited the proceeds of disposal to the investment account.
Okay, this disposal of 5%, is it going to be resulting in a loss of control?
No.
It's not going to be resulting in a loss of control, isn't it?
Yes, please.
Okay, so it means that we are still going to be consolidating. Okay, but what will happen is that this particular transaction will be between the parent, and then the what? The NCI. Okay. You see, sometimes they will not give you the net asset over here. They will not give it to you. You have to calculate the net asset yourself. You have to calculate the net asset yourself. So how do you calculate the net asset yourself? Okay, this one, if they want to calculate the net asset yourself, they will give you the net asset up to today. Or maybe they will not give you up to today, but they will give you the profit for this particular year. They will give you the profit for this particular year. So this is from January 2021 to 31 May. It means that we have sold this one 5 months to the end of the year. So it means that the reporting figure, the retained earnings at reporting, 5 months of the profit in that particular one is relating to the period after we have disposed the 5%. So we calculate 5 months of that and take it from reporting figure. That will give you the retained earnings at the date of disposal. Then you add it to their share capital. The share capital will not be changing. If there's any other results, you also be adding that one, but there's no other results over here. Okay, let's come here. You see, last time I was telling you that if you want to calculate the portion that the parent is giving to the NCI, you just find the percentage that the parent is selling to the NCI on the total net asset of the subsidiary. You use the goodwill if the fair value or the net asset or the NCI of the subsidiary is measured at fair value. How are we measuring the NCI in this particular organization? How is the NCI measured? If you come to Yarifa, how are they measuring the NCI? NCI is measured at what? At fair value, isn't it? The D. At this time, the retained earnings of this was this one, and the fair value of the non-controlling interest was 175. So we are measuring the NCI at fair value. So if you are selling, you will sell together with what? They will buy the goodwill together with what? Together with the what? With the physical asset, which is the tangible asset. So we have to ask ourselves, at this particular date, what is the value of the what? What is the value of the goodwill? Okay, what is the value of the goodwill? What is the value of the goodwill? Okay, so let me. Okay, it was determined that no impairment. It was determined that it is a policy of the group to value non-controlling interest at fair value at acquisition date. At this one, it was determined that no impairments had arisen in respect of Dodowa, but the goodwill of Oyarifa had suffered an impairment loss of 8 million. No impairment losses had arisen in the previous years or in the previous periods. So let's come to this particular one. Let's calculate our net asset fully and know the transfer that they are going to be making. Okay, so we have the net assets. Okay, the net assets at let's count the net assets at January 1, 2021. Okay, so we have the net asset that is given to us over there. Okay, that is 460, isn't it? 460,000. Okay, that is the net asset. Then we now add goodwill to it because the goodwill is not part. The NCI is valued at fair value. So if you are selling, you sell part of the goodwill to them. But we have to calculate the goodwill on this particular subsidiary first. Let's go and calculate the goodwill on the subsidiary first. What would be the Oyarifa net asset at acquisition? 50,000. I'm not sure there is any other issue that will come there. 50,000 plus 285,000 plus 285,000 minus 20,000 plus 5,000. I'm getting 320,000.
Yeah,
Yes,
320.
320,000.
Okay. So we have to add NCI here. Okay, what is the NCI for them? The question has given us the NCI. What is the NCI? That was 195,000. So we add 195,000 over here. And we bring their net asset, the total net assets. Okay, total net asset is 320,000. Okay. Then we come
Please,
to
the
this
HDI
reporting.
is 175.
Are you sure? It's 195 or OYARIFI is 195 or 175
It's
or
175, please.
175.
Yeah, D, footnote D is 175.
These dates, oh, sorry. So 175. Okay, this will be 175. And so this must also be 175. Okay. So what is the NCF for Dodowa? 80,000. So we have to add this one as 80,000 here. This will give us 430,000. Okay, what will be the goodwill in this particular organization? 268,000.
The goodwill for OYARIFI is 183,080.
183.
080.
Okay. Okay. So 183. Okay, so we have one. Let me just take the net assets straight away from them. Okay, so let's have the net assets over here to be 320. Okay, that will give us 183, 380.
080.
Okay, so let's come to this place. The question is telling us what? They are telling us the goodwill for the year is what? What is the goodwill impairment for at the end of the year? The goodwill,
8,000.
that will be 8,000. Okay, when are we selling? When are we selling the 5%?
That's general.
Okay, and the reporting date is what? 30th April, isn't it?
Yes, sir.
Okay, so the 8,000 is 12 months impairment because the goodwill has been there from the beginning of the year. So the goodwill at the end of the year, we can assume that is a goodwill arising from what? From the whole year, that is 8 million, because there was no previous impairment on this one. So that impairment is relating to only this year. Okay, so we consider the 8 million is for 12 months. The 8 million is for 12 months. Okay, we are selling the 5% on this date. First what? 1st January. Okay, it means that we have done 9 months already for this particular year before what? Before selling the 5%, isn't it? Okay, so the impairment of the goodwill, which is the 8 million, will also be a portion. So we have the 183,080 minus 9/12 multiplied by 8,000. Okay, so it means that the goodwill at the date of disposal will be the goodwill from acquisition, because the question says that there was no previous impairment on the goodwill. So the 8,000 is relating to this year. We are selling the 5% 9 months after the beginning of this year. So it means that the goodwill has impaired for 9 months, and after the acquisition, it has also impaired for 3 months. So what are we
Minus.
having? Yes, please.
Please, so is it not 8 months?
Yes, 8 months rather.
Is it 8 months? January to April.
Yeah, it's 1st January and
Yes, so
30th
January to
April, so
April,
that's 4
that
months.
is 4 months.
Oh, okay. So that will be 8/12. What are we having?
One 77746.
Okay, so 8/12 multiplied by 8,000 minus 183,080 and 83080. So, okay, let me take that one again. Okay, so what are we getting?
77746.
Okay, 177.
746.
47.
Okay, 177,747. Okay. So the total will give us what? What would be our net assets?
Three, 6, 3, 7, 7, 4, 7.
Okay. So we have 6, 3, 7,
7, 7, 4, 7.
4, 7. So what will be the transfer? What will be the transfer to NCI? So the transfer will be 0.5 of this figure. So that will be 0.05 multiplied by 637,747. So how much are we giving the NCI?
31887.
Okay. So we can make it 31887, isn't it?
Yes.
Okay. So we have 31887. But how much are we receiving from the NCI?
35,000.
So what is the difference there?
3113.
Okay. How do we treat the difference?
It goes to
So
OC,
it will be
OCE.
shared between NCI and then other reserve. OC.
No, the NCI is not going to be, the parent is the one selling. Okay, so NCI will not have any share of that. Okay, so Oyarifa is the one selling. So it will go to the other, okay. So, yeah.
So we debit NCI and credit OCE.
Okay,
Yeah.
Dodowa is the one selling, isn't it?
Yes.
Okay, so any gain from this place will be shared among the
Between,
NCI and then the parent. Thank you. Our thought is the parent is the main parent that is selling. So that difference over there, the difference over there, okay, the difference over there will be, how much is the difference? Can we take it again?
3113.
Okay, 311.
113.
Okay, 3113. Okay, if you like, you can actually include it under the what? Under the net asset of Dodowa. Okay, but it can come to the reporting figure over here. That is OCE. But since they don't have any OCE, let's go and share this among the parent and then the NCI. So this is relating to Dodowa. So this is again on Dodowa. Dodowa will be putting this under other components of equity now. This will be shared among the parents. So share of the OCE, this will be 0.2 multiplied by what? 311. Okay, what are we having? The parent will also come here and have the share of the OCE. That will be 0.8 multiplied by 3113. Okay. So this is, for these people, is what? NCI is 623. NCI is 623. Is that correct? Please, can you hear me?
Yes, NCI is
Yes,
623. Yes.
Okay. So the parent is 2490, isn't it? Okay. You can see that the question looks very simple, but somehow myself, I'm tired.
It's
Okay.
not easy.
So from January, okay, from January 2021 to the end of the year, from January 2021 to the end of the year, the NCI in Dodowa, the NCI in Oyarifa will not increase to 35%, isn't it?
Yes, please.
Okay. And this particular one will now reduce towards the 65%. Is that correct?
Yes, please.
Okay. Okay. So let's see what will happen. What we have to do at this date also is that we have to determine. So this one we are going to be determining what is the profit. So we are going to be dividing the profit into two. One of it, the parent is going to be having up to 1st January 2021, Dodowa will be having 70% of that particular share. But if you come to January to April, it will now be having 65%, where the parents will be having 80%. So you have to separate the profit into two. We are going to be doing that. So there's no issue with that. Okay. We are done with that particular one now. And the difference will be, so we have to transfer that figure to NCI. Sorry. That figure will now be transferred to NCI. What is the NCI? So we have transfer to NCI. The transfer will be what? The transfer.
1887.
Okay. So transfer will be, so that this particular transfer is for OCI in Oyarifa, but we are putting the two together. So the transfer will be 3188 what? 7. So the NCI value will now be increasing. They are buying from the parent. So this will come here as the what? As the increase in the what? In the NCI. That is 31887. Let's come to the, okay, let's come to this one. It is a policy of group to value non-controlling interest at fair value at acquisition. At 30 April 2021, it was determined that no impairment had arisen in what? In respect of the goodwill of Dodowa, but the goodwill of Oyarifa had suffered an impairment loss of 8 million. So let's go to the goodwill of Oyarifa. What is their goodwill? We have calculated the goodwill of Oyarifa. That is now, it was 183080, but they are saying that it's going to be impaired by how much?
8 million.
So we have the goodwill over here. So we have the goodwill over here. You bring the workings. So which working is that? Fine. But we are going to be having 13080 minus 8,000. Okay, that is a goodwill for the Oyarifa. Let's count to goodwill for these people. What will be their goodwill? We have done their net assets now. Can we put their net asset at acquisition together? 75,000 plus 255,000 plus 35,000 minus 8750. I'm having 356250. No, we don't send a transfer to retain earnings. The difference between them is taken to OCE, other components of equity. So the entry that you are going to be passing is debit cash. Okay, you debit cash, then you credit the NCI. Then any difference over there, we either debit OCE or you debit what? You credit the other component of equity or you credit the other component of equity, depending on the difference. It's not a gain. We don't take it to what? We don't take it to other, we don't take it to retain earnings. You only take it to retain earnings when the parent has lost control. So we are not selling the subsidiary. We only recognize the gain when we are selling. So we are not selling because we still have control. Okay. So that is why we are sharing it among the other component of equity for the parent and also the NCI. Okay. The 356250, can someone confirm that?
Yes, 35,356,250 is correct.
Oh, so we have their net assets. We have their net asset to be 356250. So what will be the goodwill?
73750.
So 73750.
750.
Okay, they say there is no impairment, isn't it? So you just come and add the 73750 here. Okay. So let's try and see if we can actually do this one now. Okay, so we are done with that particular impairment issue there. Let's come to the J.
G. On 1st May 2019, Abu.
Please, we are going to be sharing the impairment, but we are going to be sharing the impairment in two ways. But let me do the share of impairment first. Okay.
Okay.
We need to share the impairment, but we are going to be sharing the impairment in two ways. Let's come here. So the impairment is relating to Yarifa, isn't it? Okay. So this particular impairment, it is at we are valuing at fair value. So share of impairment will be this. Okay. The share of impairment, first one will be 0.44. Do we agree? 44%.
Yes.
So NPA in total is 44%, isn't it? Okay.
Yeah.
Multiply by 8 million, which is 8,000. Multiply by 8 over 12. Do we agree?
Yes.
Okay. Then this will be the first one. The second one will be what? We now have to find a new one, the new value of the NCR now. That will now be,
It's
would that be 49?
48.
We are selling 5% to the remaining people. Okay, but let's find that one.
Yes.
So 0.65 multiplied by 70%. So that will give us, so these people will now be having, we now have to reassess what? Okay, that will be 49. Okay, but you can reassess the control now. The parent will be having 0.8 multiplied by 0.65 now. Do you agree?
Yes. So that will be 52%.
That will be 52.
Yeah.
Okay.
It's,
Okay.
yeah.
Okay.
NCR will be 48.
Okay. So the 5% that they are selling to the two NCR.
Is Dodowa reduction to 65. So against the parent of 80.
Okay. So yeah. Let's move on. Okay. So that one. Okay. So it means that the 5% is not entirely sold to what? To the NCI, to the original NCI in the what? In the what? In the, yeah, okay. So this will now be 35%. And we have to reassess the what? The NCI in the Dodowa, which we'll be having in that particular one now. Okay. So that will be 35% plus the 0.20 multiplied by 0.65 now. Okay. So I'm sure this will give us 13% or something.
Yes, 13.
Okay. So that will be 48. Thank you. All right. So we have to reassess this one. Then we have 0.48 multiplied by 8,000 multiplied by 4 over 12. I hope that is okay now.
Yes.
Okay. So the parents also will be having the share of the impairment. The parent will be having 0.56 first, multiplied by 8 over 12, multiplied by 8,000, because it's a full year impairment. Then the second one will be 0.52 multiplied by 4 over 12, multiplied by 8,000. So the impairment is full year. So the parent was having 70% up to 1st January, and they are now having 65%. So you have to recalculate the parent indirect interest now. So from that date, Dodowa will be having 65% of any of the returns, and the parent will be having 80% of that. So from that day, the parent is having 52% now. So what will be the goodwill share? The first one will be, we'll be having 8 over 12 multiplied by 8,000 multiplied by 0.44. I'm having 2,347.
7. Yes.
Okay. 2,347. And the second one will be 4 over 12 multiplied by 8,000 multiplied by 0.48. I'm having 1280.
Yes, 1280.
Okay, 1280. This one you can decide to eliminate these things for the parent and just find the difference, because they are sharing 8,000. Okay, they are sharing 8,000. So if the first person is having 23 plus 12.1, what would be the difference? So you can find that difference for the parent now. Okay. So the first one will be 2986. Is that correct?
Yes.
Okay. And 2986, and that will give us what? The second one will give us what? 2347 plus 1280 minus 8000 minus
1386.
2986. Okay, I'm
1387.
1387. Okay. Let's take the last one now. Sorry, I'm tired of. Hey, let's move on.
Charlie, we self retire.
Okay.
You
But
force,
you've done well.
you
You've
force,
done
Linus.
you
great.
force,
You fought
force.
were
Hello, Linus.
you
Yeah.
fought were seriously.
Oh, please, can we go to the NCI? I'm a bit confused with something there.
Oh, you have library there, but you're on campus.
I won't mind you, Linus. I won't mind you.
Okay, let's take this one again. Okay, which one?
Yeah, the share of OC. Why are we using the 20% as a share? I'm a bit confused there.
No, the share of the OCE, it is for Dodowa. The OC is for Dodowa. Dodowa is the one selling. Auntie Vic, are we together?
Yes, please, I'm here.
So Dodowa is the one selling to those people. Dodowa is the one selling. So if Dodowa is selling, it means that this particular OC, the difference will be taken to OC of Dodowa.
Okay.
And Dodowa is owned by 80% of the parent and 20% of the NCI.
Yes, please. Thank you.
Okay. So let's take the last one, then we find the post-acquisition one now. Then we discuss the footnote for the step acquisition. That is also an interesting area. Let's take the J.
Footnotes.
Auntie Vic, are you the one that your place is noisy like that? Okay, Auntie Vic, you can talk now.
Okay. Oh. Footnote J. On 1st May 2019, Abokobi made an award of 800 share options to each of its 7 directors. The condition attached to the award is that the directors must remain employed by Abokobi for 3 years. The fair value of each option at the grant date was 100 cedis, and the fair value of each option at 30th April 2021 was 110 cedis. At 30th April 2020, it was estimated that 3 directors would leave before the end of the 3 years. Due to an economic downturn, the estimate of directors who were going to leave was revised to 1 director at 30th April 2021. No directors has left by 30th April 2021. Abokobi is here to account for this scheme in its financial statement since the grant date.
Okay. So this is a share-based payment transaction.
Share-based payment.
Okay. Sometimes they have been taking the footnote and bring it in the exam. Okay. So this particular award or this particular option was given on 1st May 2019, and we are reporting on 30th April 2021. That is 2 years from the date that the options were granted, isn't it? Okay. But what we are going to be doing here is we are going to be doing it for the 2 years. Since if you are doing statement of profit or loss, then you do only this year's figure. But this one, we are doing statement of financial position. So we do it on cumulative basis and send the figure there. But I'll do it each year so that if you go and make the same question for statement of profit or loss, we send the transactions or the issues that happened during the year to that particular one. That's what they say for the year. It's just for the year, for just 1 year. So if there was a fair value adjustment that has been there for 4 years or what, you just find just that year depreciation or that year adjustments and send it there. But this one, we are doing statement of financial position. It means that they haven't accounted for the 2 years all, but we are going to be doing it one by one. Okay, let's come here. The first year of this particular one will be 30th April 2020. Do you agree? The first year of service will be 30th April 2020, isn't it?
Yes, sir.
Okay.
Sure.
So the condition attached to the award is that directors must remain employed by Abokobi for 3 years. The fair value of each option at the grant date was 100, and the fair value of each option at 30th April was 110. This is what? Equity. We are going to be giving them equity, isn't it? So equity,
Yes, sir.
once measured, cannot be remeasured. So we use the fair value at the grant date. They can give you so many fair values. Use the one at the date that you are giving the options to the people. Okay, so the fair value of each option at the grant date was 100, and the fair value of each option at 30th April was 110. Okay, at 30th April, it was estimated that 3 directors will leave before the end of the 3 years. Please, this is a provision. We make the provision. It's a provision that we are making for the future. So if you are owing me and you want to provide, you make the provision as if you are going to be paying me today. That's how we do this one. It's just like you have 5 children that you want to have one story building for them at the end of the 5 years. But you have realized that no, one of the children will not be there at the end of the 5 years. So as of today, you are going to be making provision towards only 4 children, although you are going to be giving it to them at the end of the 5 years. But one person will not be there. So as of today, you are going to be You are going to be saving for only 4 children, because you know that one will not be there. So the same way we do the provision. We do the provision as if we are going to be settling these people today. So if today we are saying that 3 people will not be there, 3 people will not be there, it means that from today we have to be making provision for what? For 4 people. You are doing wedding, they say that 1,000 people will come, and someone is telling you that, okay, it is possible that 300 people will not come. You will not make provision for all the 1,000 people. You will now be making provision for what? 700 people, although you are not going to be doing the thing today, but you are making a provision as if the thing is happening today. So you are going to be providing for only 700 people for the event, which will happen in the future. The same thing to what? To the share-based payment. We make the provision to cover only those that will be there at the end of the service period. Okay, so let's count to the first year. Let's count to the first year. So we made a provision as if we are going to be settling this particular transaction today. So let's come to okay. So let's come to this particular one. So we come to the share-based payments. Share-based payments. Okay, so for the share-based payments, so we do the first year, although we can do it for just a year. Okay, we can do it for only the 2021 and take the figure there, but we do it, maybe they might give you for statement of profit or loss. So we do it for each of the years. So you do 30th April, which is the first year, 2020. So we can do April 2020. Please, the provision is made at the end of every year. So if they are giving you any figure at the beginning, ignore. You use the what? At the end of the year estimate. So this one we have the staff expense, or some people will call it staff cost or remuneration expense. That will give us, so at the end of April, we are estimating that 3 people will not be there. So it means that we are going to be, if it is food that we are going to be giving to them, we now be making provision for only 4 people, because to be only 4 people that will be there to eat this particular thing. So we have 7 minus 3, okay, multiplied by the option. So 4 people will be there, and each person will be receiving 8,000 multiplied by the fair value at the grant date. That will be 100, isn't it?
Yes, sir.
Yeah,
Okay.
100.
So that will be 100. We are making a provision as if these people, okay, so if you are paying the people now, this is the amount that you are going to be paying them. But you are going to be paying them at the end of the 3 years. So they have to work over 3 years. So you spread your what? Your expense over 3 years. What are we having for the first year? Or you can multiply by, let me not confuse you. Let's multiply by 1 over 3 here, so that we conform to what we know. Okay, what are we having? which will be the cost for the first.
1067.
Okay, 1067 for the first year. Let's count to the April 2021. This is done on, this is a provision. Provision is based on cumulative basis. We make provision on cumulative basis. So in the second year, the number of people that are living now has revised to what? Has been revised to
one.
So at the end of the second year, we are now expecting 6 people to be there, isn't it? So we have to
Yes.
revise our provision now. So we have to revise our provision 1 minus 1 multiplied by 8,000 multiplied by 100. Then we do cumulative basis 2 over 3. What are we having?
3,200.
Okay. So 3,000.
200.
Okay. So the staff, this is on cumulative basis. So the staff expense that will be there should be how much? The difference between the staff expense or the cost for the second year to be the difference between the two. 2133, isn't it?
Yeah, 200.
Okay. So if you are doing profit or loss, please, if you are doing profit or loss, this is the provision. We just find the difference. So you take 2133 as administrative expenses. But this one, we are doing it statement of financial position. They haven't recognized the expense for the 2 years. So we are going to be using this figure. So it means that they haven't recognized this and they haven't recognized this one also. So we put the two together. So that's why I'm saying that we can just stand up. Since we are doing it for statement of financial position, we can stand up and do it for the 2 years together and send it over there. But I'm doing it one by one because maybe if you see a question, that will be a question on its own, then you know what to do. So it means that they haven't made any provision for this one. So we now debit our group return earnings because it's the parent that is doing that, and we credit other results. This will be going to other components of equity. So that will be 3,200, 3,200. So we go to our other results, which is the share options of 3,200 as an addition, but the corresponding entry will be staff expense for 2 years. So we have staff expense for 2 years. So that will be 3,200. Okay. Auntie Vic, I hope you're okay with the 3133 now. 3113.
Yes, please. I'm okay.
Okay. So let's come here. We are done. How do we share the profits now? The share of the profit for Dodowa, we don't have any problem with that one. It will be shared among the parent and then the NCI, 80 against 40. But the profit of Oyarifa, that is what we are going to be looking at now. Let's look at the post-acquisition profit for the parents. 75,000 plus 52. So we just have 52. Do you know that you can find a profit without adding all the figures? Do you know that you can find a post-acquisition profit without adding the figures?
Yes, please.
How do you do that?
The difference between the retained earnings.
Are you sure? I'm having 254729 as the post-acquisition profit. Is that correct? Can someone confirm that?
Yes, right. 254729.
Okay. And Auntie Vic, don't worry. You have an idea, but I will show you. Okay. 254729. So this will be 60610,979. Okay. Let's come here. You can see that this against this is 0, isn't it? Okay. The post-acquisition profit over here is actually between, the profit is included in retained earnings. What is the difference over here? The retained earnings, what is the difference?
$270,500.
Okay. Okay. But what the question that you have to ask yourself is that what is that? What is that profit or loss item that should have been taken from the profit, but has not been taken from the profit? And that one is only the finance cost. You can see that deferred tax is having a zero effect. 8750, 8750, there's no problem. The only thing that is going to be affecting the profit, the only thing that they have to subtract from the profit, but was not subtracted is the finance cost. Finance cost should have been subtracted from the profit. So it's just subtract the finance cost from the difference. The PPE is not bringing any depreciation, that is land. So if you subtract, you'll be getting your answer and you can just put it there and move on. And this particular figure, there is no portion of what OCE in it because they don't have OCE. So this will be a profit share among the NCI and then the parents. So we have the share of post-acquisition profits. That will be for Dodowa, that will be 0.2. That is a profit relating to Dodowa. Anything relating to Dodowa will be 20 against what? 80, 254729. Okay, you come to the parent own over here. Share of post-acquisition profits, 0.8 multiplied by 254729. But let's come to the profit of the Oyarifa now. A very interesting point. Okay, we have to find a profit when the parent was having, when Dodowa was having 70%. And we also have to find a situation where Dodowa is now having 65%. I hope that is okay now.
Yeah.
Okay, so let's come here. January 1, they have given us what? January 2021, they have given us a net asset, isn't it?
Yes.
Okay, and the net asset was 460 million, isn't it? Okay.
Yeah.
How do we calculate the net asset? It is the share capital plus the retained earnings up to this date because they don't have OCE. Okay, the share capital is not going to be changing. So if net asset is there, the net asset is what? Is the share capital plus the retained earnings plus any what? Any reserves or any post-acquisition adjustment because they are saying that the net asset we verify identifiable net asset as appropriately adjusted for consolidation purposes. As appropriately adjusted for consolidation purposes is what? Is 460. It means that how do they calculate this one? They have done the actual thing that's supposed to be done. What is the actual thing? They have their share capital, they have their retained earnings, and they have added their what? Their fair value adjustment. Okay, they have added their fair value adjustment, and they have also subtracted what? The deferred tax from it. That is why they are saying that they appropriately adjusted for consolidation, appropriately adjusted for consolidation. But you can actually, because the deferred tax issue is going to be making things complicated for you. So what we do over here is that they say that the net asset appropriately adjusted for consolidation purposes is that particular figure. So this is what we are going to be doing. Okay, this is what we are going to be doing. A very simple exercise over here. If the net asset over here, was 460, the net asset at this date was 460. What is the net asset at reporting?
473750.
Okay. So if net asset at the date of disposal is this one, net asset at reporting for them was 6161. Oh, sorry.
Oyarifa.
Oh, sorry. So Oyarifa is what?
473750.
Okay. 473
750.
75.
Zero.
Okay. 473750. Okay, 473750. So if net asset at January is what? Is 460,000 and net asset at reporting now is 473. What is the profit that was made between January and April?
13750.
13 what?
750.
Okay, So let me do this one very well. Let me do this one very well. So we are going to be looking at the profit between January and April. That will be 2021. Okay. So we have the net assets at reporting. That will be reporting. And that was 47350. So we have 47350. And the net asset at the date of disposal. Net asset at the date of disposal. Disposal was 460,000. It means that from January to this one, that is the difference between. So from January to April, they have made a profit of what?
13,750.
13,750.
No.
Okay. Then, what was our net asset at acquisition?
320.
320. So from acquisition to what? From acquisition to, so we are going to be finding our profit now. So we start from acquisition to what? The date of disposal. From acquisition to the date of disposal. From acquisition to the date of disposal. The difference between them over there should be between the retained earnings and OCE, the OCE, but they don't have OCE. So we come to January 1. January 1, net assets at the date of disposal. Net asset at the date of disposal will be, that was 460,000. And the net asset at acquisition, net asset as acquisition was 320. Okay, the difference between this one will be the only thing that increases, that will be 140,000. The only thing that increases net asset is what? Is the profit made for the year or movement in OCE. But these people, they don't have OCE. Okay, so this profit will be like this. So the share of the profit relating to the oil refer will be in two folds. So the parent will be having 0.56 multiplied by 120.
140.
Okay, 140.
140.
Okay. Then they will have 0.52 multiplied by what?
13,750.
13,750.
750.
Okay. NCA will also be having the same thing. So let me put the NCA here. Share of the post acquisition. NCA will be having 0.44 first, multiplied by 140. Then now plus 0.48 multiplied by 13750. Oh, that is fine now.
Yes.
Okay. So that's how you find the profit. The profit, you have to divide the profit into two. Okay. You have to divide the profit into two. First, the parent, Dodua was having 70. So the parent will be having 80% of that. Back to some point, Dodua has sold what? 5% of that. So it means that Dodua will now be having 65%. So you have to now find Dodua 65% of the profit and find the parent share. So that's what we do on indirect what? Basis. A very simple exercise over here. Let's use the remaining 20 minutes to discuss the step acquisition question there. Okay. We have 20 minutes. Okay. Let me see. Okay, let me use the 20 minutes to, because we have done this thing already. We have done step acquisition already. We have solved two questions. Let me use this to discuss the what? The foreign subsidiary, which we haven't done. Okay. Okay, foreign subsidiary, what we have to do is that if you are consolidating, the consolidation is the same thing. Okay, consolidation is the same. So we calculate the goodwill in the same way. We calculate the net asset in the same way. We do the console, everything is the same way, but just that the figures are going to be different. So if you are doing statement of financial position, you go and look for this statement of financial position. You go and look for the statement of what? The exchange rate at this particular date. The question will give you the exchange rate at the reporting date. So what you do over here is that you do 297 plus 146. This is a different figure. So you either add or divide, depending on what you are doing. So you use a closing figure for the statement of financial position when you are translating. So if you come here, our rate at 30th April 2x4 is 2.5. So we translate this by 2.5 if we are dividing. But if you are multiplying, you just use the closing rate. If you count to statement of profit or loss, we use what? The average rate. So if you are consolidating over here, this is what you do. Okay. If you are consolidating the subsidiary, which is with the what? With this figure. So this is what you do. Let me just show something over here. You have a revenue. Memo will be the parent. So you have the revenue, which will be 200 plus 148. So if you are dividing, in most cases you'll be dividing. So you use the average rate. If there is any intra-group trading, you just come and subtract. Okay. Cost of sales too, you do the same thing. You pick the parent on 120. Because this particular one is in a different currency, you have to present the financial statement in the currency of the parent now. So you have to bring that one. Then you now have 96 divided by 2. So you are translating. $1 is equal to, I'm sure $1 is equal to this particular, 2 of this particular one. So if you are changing now to dollar, I'm sure you are going to be dividing. You just have to establish whether you are dividing or you are multiplying. Just how we do the translation or how we do exchange rates. How to change one figure to one currency to the other one under the IS-21, the same thing. Gross profit, you don't do anything. It's the same thing because if you subtract your revenue or you subtract cost of sales from revenue, you'll be getting the gross profit straight away. Then you count your distribution administrative expenses. You have 30 for the parents plus 20 of this one. You translate using average rate. The question will give you average rate divided by 2. So it means that this one over here is 10. This particular 10 is in the dollar now. Okay, it can be a full year. It can also be half a year. Okay, so if it is half a year, you first of all have to do 6 over 12 multiplied by 20. Then the answer that you get, you divide it by 2. So you'll be having 10 divided by 2. Okay, you have to prove that before you translate it. Okay, if you count operating profit, anything about profit, we don't do anything because profit are resultant figure. So if you do your figures well and subtract them, they will be coming. So we don't do anything about profit. If you count investment income, it's only the parent that is having finance, the investment income. The finance cost, the parent is not having. So this will only be 2 divided by 2. Average rate is 2. If you count to income tax expense, this will be 20 for the parent, which is in dollar, plus you are changing the subsidiary own to the parent own. That will be 9 over 2. Assuming that it's a full year, it's a full year acquisition. But if it's 6 months or 9 months acquisition, you first of all do 9 over 12, multiply by this one. The answer that you get, then you transfer that answer using the average rate. The profit for the year, that is it. Statement of financial position, we use the closing rate. What do we mean by the closing rate? The rate given to you at the date that you are preparing the statement of or you are preparing the statement. That is what we do. Okay. We have done step acquisition. We have done issue of cash flow. Okay. That is well. Okay. We have done the cash flow also, but the cash flow you just have to reconcile. Reconciliation means that whatever statement that they have been giving to you, it means that the correct thing has been done by the parents. Everything in the footnote, they have accounted for it in the correct way. So you just want to know how those figures should have been gotten. So how was this particular figure gotten for PP? How was this figure? They have done the correct thing. They have done the correct treatment. They have separated depreciation. They have added revaluation surplus. So you will now ask yourself, if I'm giving opening figure, how do I get the closing balance that they have gotten over there? So if you have PPE, then you have to add acquisition for the year. You have to subtract depreciation. You have to add revaluation. If there was any disposal, it should be taken. These were the things that they have done before they have gotten the PPE. So you have to do the same thing to know the difference will either be a depreciation if you are not giving depreciation. The difference will just be acquisition of new items. So you are just reconciling the NCR that they have. How was the NCR arrived at? How was the closing NCR arrived at? They have taken the opening NCR, then they have added NCR share of the profit for the year. So this is the figure that they should have. This is how they have gotten that figure. Is there any difference between the figure that they should have gotten and the figure that they are presenting? The difference over there will be the dividends received by the NCR or the dividend paid to the NCI. Return earnings. How do I get the closing return earnings for the parents? I will take the parents' return earnings at the beginning of the year, add the parents' share of the profit for the year, then any dividend will be taken away or any bonus issue will be made. Then you calculate how the figure should have been gotten and what is the figure that they are reporting. How was the closing figure ascertained? They will take the return earnings at the beginning, add the share of the profit for the year, and if there's any dividend, they will take the dividend from it. Then they will be having the figure that they had over there. But if the figure that you are having is different from or is higher than the figure that they are having, it means that they have paid dividends. So they have taken the dividend from the figure that you are having and they have the figure reported over there. So that's how we do the cash flow. We just reconcile all the issues. Just reconcile them. Any issue. We have used the two questions to demonstrate at least everything that you have to know under consolidation. Please, you can go to exam, whether it is statement of profit or loss, statement of financial position. You can't do consolidation without fair value adjustments. So you have to know about the fair value adjustment. If there's a fair value adjustment, it's going to be bringing issues of additional depreciation if it's upwards. If it's downwards, it's going to bring an issue of overcharging of depreciation. Okay. Then that particular fair value adjustment can also bring issue of deferred tax. For corporate reporting, they will ask you for the deferred tax adjustment unless the examiner wants to have mercy on you. They will bring issue of deferred tax issues relating to the fair value adjustment. There is going to be an issue of intra-group trading. Okay, intra-group trading. Please, you don't have to understand. How do you treat it? If it is statement of financial position, identify who is selling. What is the provision for analyzed profit? Take it to whoever is selling. The profit is included there. Go and subtract it. Then go and take it from inventory. If you are doing statement of profit or loss, remove all the sales. So the total value of the revenue, remove it. But the sales that we are looking for is the sales after they have established the subsidiary parent relationship. There can be a sale between them before the acquisition. That sale was like a sale between third parties or a sale to a third party. So we pay attention to only the post-acquisition sales. They can give you a question where they will be saying that the sales have been consistent for this month, but the parents acquired the subsidiary 9 months to the end of the year. It means that the parents have sold to the subsidiary for the first 3 months. Within that particular first 3 months, there were no relationship between the parents and the subsidiary. So the sale was like a sale to a third party. We only pay attention to the time that they have now established the subsidiary parent control. So we pay attention to the post-acquisition sales. So you find that you remove the sales if you are doing statement of profit or loss. Then you bring in the what? You debit, or let me just put it like this. You take the revenue from the revenue, you take it from cost of sales again. Then you determine the what? The provision for analyzed profit and add it to cost of sales. That's how you treat it. If you want to understand, then you have to go and watch intra-group trading. It was like 1 hour. Okay, if you watch the intro to group accounts, the one that we have done, I don't think that you are going to be having problem with consolidation adjustment again. It's not anything. 20 marks, just at the time, or the footnote is going to be plenty for you. Okay, you cannot have group account without a transfer of PPE. Okay, you cannot have a group account where there will be a transfer of PPE. That is also there. You can also not have a group account where there will not be intra-group trading. You cannot have a group account where you will not have issues of fair value adjustment. Those three there, you need to have them. You need to know how to adjust them. How to also calculate the purchase consideration. Okay, how to do the net assets. Yes, that is all. If you are okay with those issues, I don't think you have to have problem with the consolidation. So please, this is how far we have come. So tomorrow we will do standards. So maybe tomorrow in the morning, I have to put the standards together because I have the questions scattered. So I have to put them together. Then we see what we can do tomorrow on the standards. Okay. Any issue? Okay. Dividend received from who? Subsidiary. Okay. Dividend is paid out of profits. Okay. So if you are doing statement of profit or loss, and the question is telling you that the dividend received from the subsidiary is included in the what? In the investment income of the parents. No, dividend is paid out of profit. The parent is going to be having a share of the full profit, which is including the dividend. So you take the dividend from the investment income because at the end of the day, the profit that is made by the subsidiary, the parent will share it. So the parent is having a share of the full profit. They are paying the dividend out of the profit. So if it is profit or loss, it means that they are going to be taking what? They are going to be taking that investment income because the dividend is already included in the profit that they are sharing. Okay. But if you are doing statement of financial position, we are using retained earnings. How do we get retained earnings? The retained earnings is calculated as profit for the year plus opening balance minus the dividend. So it means that the profit that you are going to be getting under the net asset is a profit after dividends. So what you do over here is that if you are giving a dividend, you add the dividend to retained earnings. Then you also take their share of the post-acquisition profit because the profit that we are sharing is the movement in retained earnings, which the dividend has already been taken out of it. So we are sharing profit before dividends. Profit after dividends rather, sorry. Profit after dividend, that is under the retained earnings, the net assets. We are using retained earnings. Dividends has already been taken. So the profit over there is profit after dividends. So it means that dividend is part of the profit. So take your share of the dividend to retained earnings and a share of the profit also, which is the profit up under the net asset. That is after dividend. So you treat the two of them as income to the group retained earnings. Okay. If the parent is yet to receive any cash from them, if the parent is yet to receive any cash from them, what will happen is that the subsidiary will be treating the dividend as payable, and the parent will also be treating each share as what? As receivables. That is an intergroup trading, intragroup balances. We cancel it. So if the subsidiary is sharing, subsidiary is paying a dividend of 10 million. Okay. Please, I'm saying that under the net asset, we use retained earnings. How do we determine retained earnings? The profit that is being sent over there is after dividends. So dividend has already been taken out of that one. Okay. So if a dividend is 10 million, the parent is having 8 million of this one. And the profit made for the year or the profit for the net asset is 200 million. Okay. The profit that we are getting over there is from retained earnings, which is profit after deducting the dividends. So it means that the profit that should be made for the year was 10 million. Okay. So the parent should have a share of 210. But they are having a share of only what 200 because 10 million out of this is dividend. So the parent will find each share of this one and a share of the 10 million also as dividends. So the parent will be having the 8 million as dividends. If the parent has not received cash, the parent will be treating the dividend receivable as what? As receivables, current assets. The subsidiary will also be treating 8 million owings to the parent as what? As payables. And 2 million will be for the NCI. What you have to do is that come to the payables of what? Come to the payables of the subsidiary. Then you now have 10 and take 8 million out of it. Why are you taking 8 million? Because the 8 million will be treated as receivables of the parent and payables. That is intra-group balances. Take it off. And you now have only dividend payable to what? To the NCI. So what you have to do over here is you are going to be debiting payables of 8 million and you credit what? The group retained earnings of 8 million. That is the entry that you are going to be passing. Senior, I don't know whether I have answered your question now. Okay.
Hello, sir.
Yes, please.
Yes, when a parent purchases a subsidiary,
yes, please.
Will the loan notes that are also purchased, will it be part of the consideration?
No, please. Loan notes are liabilities. So it's the only time that you can have control is to purchase equity shares. you want to be the owner of the company. You want to be part of the owners of the company. So you have to participate in what the owners are using. That is equity shares. So if at acquisition date, they are saying that the parent has acquired the loan notes. You see, after the acquisition, the parent will now be the owner of the subsidiary. So everything belonging to the subsidiary will now belong to the parent. So the liability of the parent, liabilities of the subsidiary will now be the liability of the parent. So if the parent is now purchasing that, it means that the parent is paying its own creditors back. So that will be treated as payment of your own creditors. So any transaction on that have to be reversed. Loan notes, preference shares does not give ownership. The only thing that you treat as part of the purchase consideration is the amount that you are paying for the equity shares. It's only equity shares that will give you ownership. So if there's any issue of loan note, the parent will be treating it as either a financial asset or it will be part of the consideration. Please go and remove it. Because after you have acquired, okay, let's come to this place now. Okay, let's say you have acquired 80% of the company that I own. So it means that any obligation that I'll be having, you'll be having the same obligation too, because literally you are the owner. So if I'm having loan notes of 80 million, it means that you are also owing these people 80 million. So if you decide to purchase part of this one, it means that you are paying your own liability, because this is also your own liability, because you are the owner of the company now. So you are owing these people. So if you are purchasing, it means that you are paying back the money that you are owing those people. So that should be treated as paying back of the loan, not investment in the subsidiary. But in their separate financial statement, they are going to be treating this as a liability and also as an asset. If you come as one entity, we are now one entity. So what we are doing now is one. So it means that the liability of my company is the liability of your company. So if you are paying back, it means that you are paying the people that we are owing. So we have to reverse that. So you have to take it. Any interest on that have to also be reversed. So the parent will be having finance income that must be reversed if you are doing a group account, because the company is not a one company, one entity. If I'm also treating that as a finance cost, I have to reverse that one also. So we reverse everything. So now I hope you are fine with that now.
Yes, please. Yes, please. Thank you.
Okay. So the only thing that gives ownership is equity shares, even if they are buying preference shares, no. But the parent can actually issue preference shares in exchange of the consideration. That's a different issue altogether. The parent is paying with preference shares. That is just like share exchange. That's a different issue. Maybe the parent is buying loan note or preference shares. That should be treated as what? As a payment to the what? To the preference shareholders. Because at the group level, we are one entity. All right. Any other issue before we go? All right, if there are no issue, thank you for, sorry for bothering you, and thank you for coming. And tomorrow we'll look at some of the standards that we think might be appearing in the exam, but we are going to be looking at the advanced side of the standard. So if you are coming here to do maybe borrowing course, and the borrowing course will just be some small borrowing course, no. This is corporate reporting, not financial reporting. So we need to differentiate between corporate reporting and financial reporting. So we are going to be doing that tomorrow. So I will put the questions together. Then tomorrow in the morning, I will deliver them. Then we see what we can do. Small, let's see where we can go. Thank you for coming. I'll see you guys tomorrow, same time. Have a good day.
Yeah.
Bye.
Thank you.
Thank you.
God
Thank you
bless
so
you.
much.